all of these high momentum stocks have started to pull back pretty significantly. And we think it's just an unwind of that crowded positioning.
I don't know that it would necessarily be a bad thing to see that broadening out in terms of performance.
Some taking of gains is to be expected after such a strong fourth quarter, all to be expected and could also be attributable to seasonals.
A key pillar of this bull market has been the resilience of corporate earnings.
If you can't see earnings broaden out, then it's a huge problem in the market today.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get your week started live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Monday, coming off the back of a 2-week losing streak on the S&P 500. Equity futures bouncing by just 0.3%. Your scores look like this as we go into a massive week ahead. Payrolls on Friday. Chairman Powell addressing the nation as well. Look out for that at the end of the week. Before we get there, a tariff deadline in the next 24 hours, setting the tone for this market worldwide. 25% on imports from Canada and Mexico, an additional 10% on imports from China.
At a time when more broadly the market is positioned that these will not go on and that essentially this will be a negotiating tool. Companies, however, are taking this seriously. And some of the data that I thought was most interesting last week was that the trade deficit for January for the United States surged by 25%, with the expectation that a lot of companies are trying to get ahead of these expected tariffs, bringing a lot of imports. Guess what? Boosting Chinese manufacturing production in the period of time.
Howard Lutnick, President Trump's Commerce Secretary, went on Fox over the weekend and said it's a fluid situation, meaning obviously talks are ongoing and there could be potentially come to an agreement between both these countries to not have the tariffs go in place. But then he goes on to say there are going to be tariffs on Tuesday on Mexico and Canada. Exactly what they are, we're going to leave that to the president and his team to negotiate. So it sounds like tariffs are going on, but maybe the level might be toned down.
And then we've got reciprocal tariffs in early April. So a month from now, Europe, believe it or not, has bigger problems. When the defense sector rallies this hard, you know something has gone wrong in diplomatic talks. Rheinmetall, BAE Systems up by more than 10%, a double-digit rally. Check out this from Reuters over the weekend. Economists advising the parties that will likely form a new government in Germany. They estimate around 400 billion euros are needed for the defense fund and 400 billion to 500 billion euros for the infrastructure fund. That is one heck of a story out of Reuters.
And frankly, it would account for a huge proportion of Germany's GDP. It would be a complete reversal of what we've seen over the past 80 years since 1945, when the U.S. essentially provided the defense mechanism for the entirety of Europe. Let's put this into perspective. U.S. presidents going back to Nixon have wanted the European Union to spend more on defense, and they haven't. There is a real question about whether what happened on Friday will galvanize Europeans to actually pull together some defense fund. What I'm watching is the bond market. How do they fund this? And do you start seeing some sort of sell-off in European bonds as they anticipate this? Or do you have a rally in as people expect this to ultimately come at some expense of growth? But to me, I'm looking for that bond market reaction.
Friday's Oval Office blow-up really led to what we're seeing this weekend happen out of Europe. Even more European leaders coalescing around this idea that they need to step up when it comes to their own defense. I will note, though, Mark Rutte, the NATO Secretary General, did say, please, let's stop gossiping about what the U.S. might or might not do. They are in NATO. They are committed to NATO. But this president has made it very clear he wants to see Europeans spend more when it comes to defense.
We've got that bond market reaction. German bond yields higher by 7 basis points on a 10-year maturity. Deutsche Bank saying this, the real possibility of, quote, a fiscal regime shift of historic proportion. We begin the program this morning, and good morning to you, with a rupture in transatlantic relations.
Mr. President, with respect, I think it's disrespectful for you to come into the Oval Office and try to litigate this in front of the American media. You should be thanking the president for trying to bring an end to this conflict.
Have you ever been to Ukraine that you say what problems we have?
I have been to...
Come one.
You're not in a good position. You don't have the cards right now. With us, you start having
not
cards.
Playing cards.
Right now, you don't. You're playing cards.
Mr. President.
You're playing cards. You're gambling with World War III. And what you're doing is very disrespectful to the country.
Have you said thank you once this entire meeting?
A diplomatic breakdown in the Oval Office fueling urgency in Europe as leaders there spent the weekend looking to build a so-called coalition of the willing.
We are at a crossroads in history today. This is not a moment for more talk. It's time to act. The UK is prepared to back this with boots on the ground and planes in the air, together with others, Europe must do the heavy lifting.
Our team coverage begins right now with Bloomberg's Tyler Kendall in Washington, D.C. and Oliver Crook over in London. Ollie, did we make any progress at all over the weekend?
I mean, I think to a degree, Jonathan, I mean, it's sort of, I think that when you see the reaction in the market, at very least, you start to see that, the market is taking this very seriously. We thought, a lot of this rally has already been priced into Rheinmetall, all of these companies catching a two-digit percentage bid this morning in the sort of promise that things are going to change here in Europe. And for the European leaders, they talk about this sort of coalition of the willing. What they have not yet answered is the coalition of the willing to do what, right? One is going to be the money component of this. The EU and other sort of pan-European projects, there's a lot of different ideas floating around. They have not yet coalesced under something very concrete. Obviously, the sort of biggest measure that they could put forward is something around the joint debt, but there are other workarounds and other little things that they could be doing in order to do it at the very European level. There is at the national level, we're starting to see willingness there. You mentioned some of the news out of Germany. They're really looking to move really in a very big way on defense spending, circumventing the debt brake quite possibly in order to get where they need to go. But then there's this final question here, John, about the sort of security guarantees that Europe is able to provide. When they talk about troops on the ground, are they troops to do what? That is the question that I get back from every European leader and lawmaker that I speak to. Are they there just to sort of observe that the conditions for peace are being maintained, or are they there to return fire on Russian troops if, in fact, that ceasefire is broken? And that is a very difficult thing for a European leader to sign up to, particularly without those American security guarantees, which really hang at the center of all of these conversations.
Tyler, President Zelensky said over the weekend when he was at that summit in Europe, if the U.S. president invites him for a constructive dialogue to solve real problems for serious issues and real decisive actions and answers, I will arrive. The question is this White House prepared to extend another invitation?
Well, Annmarie, the biggest question on the table here is something that was consistent from Trump administration officials over the weekend, which is that they do not want to discuss any part of these security guarantees at this moment. And it was interesting to see some of the rhetoric come out of senior administration officials, right? Treasury Secretary Scott Bessent, for example, telling CBS News that at this moment, the, quote, sequencing of negotiations is just totally thrown off. The White House had wanted Ukraine to sign this critical minerals deal, and then they would move into brokering that longer peace deal. But at the moment, Scott Bessent is suggesting that that economic cooperation deal could be off the table depending on how Zelensky responds. You read his response right there. The Ukrainians saying that they would go back to how that deal was currently negotiated, and Zelensky would come back to the White House if invited for serious talks. But at least one European official is telling Bloomberg News that in private conversations, this White House is looking for a public apology from Zelensky, something so far he has steered clear of. Instead, Annmarie saying that he has a right to have an open dialogue about the future of his country.
Tyler, Ollie, to the both of you, thank you. Let's extend the conversation. Joining us now, Norman Roule, the former senior US intelligence official. Norm, welcome back to the programme, sir. How does Zelensky, the Ukrainian president, come back from this?
Good morning. With great difficulty. Friday's terrible meeting basically is a first. It's not uncommon that U.S. leaders and their interlocutors have contentious, even angry discussions in private. It's certainly common for each to play to their base in public. But what we saw was a fairly honest and open conversation that became quite heated from the two sides. At this point, the Trump administration will require Zelensky to show remorse for his actions in the Oval Office, and Zelensky is going to stick to his guns about looking for some sort of security agreement. I think the primary goal of each side is going to remain the mineral agreement, and it may be that Zelensky's ministers or some intermediary group signs that when that comes about, because the Trump administration does see that an economic relationship is the first step to building a security agreement. I don't think it's going to happen soon. I think Europe is going to push for this, and events will be one of the pressures for the Zelensky government.
Norman, over the weekend, I was told by a senior U.S. official that the mineral economic agreement is off the table for now. That key point, you think at the end they want to get to it. What kind of timeline are we talking about?
Impossible to say, because this is now a political issue. It's a highly partisan issue in the U.S. We've not had an issue of this, a foreign policy issue of such partisanship since the Iran nuclear deal. As I say, events are going to dictate the pace of some of this. But in the end of the day, the Ukraine must have U.S. support. The U.S. will not provide that support without some different type of arrangement with Ukraine that involves economic compensation for our expenditures. And Europe wants Ukraine to maintain this tie to the U.S. So I think you're going to see a process, but it's impossible to predict when this will come to a conclusion.
Can an economic agreement act as a deterrent to Putin in terms of militarily?
It depends. An economic agreement that is only something on paper, that is not fleshed out, that doesn't involve a significant U.S. commercial presence inside of Ukraine will not be a significant deterrent to Vladimir Putin. But if there are broad economic interests and these economic interests are important to the U.S. economy, then Russia will have to take that into consideration for its moves. Now, there's a reverse to this. If we have significant exposure in Ukraine, then that becomes in some ways a potential vulnerability. So you're going to see the Trump administration likely widen its mineral acquisition approach worldwide to prevent that from occurring. But it all depends on how quickly this can be executed.
Norm, you mentioned how partisan this has become in the United States. And the Pew Research put out a poll about mid-February, so before this meeting, showing that Republicans and Republican-leaning independents are far more likely, about 47%, than Democrats, to say that the U.S. is giving Ukraine too much support. That number for Democrats is about 14%. How far does this extend in terms of different views of the U.S. role in the world and who the allies and who the enemies actually are?
Well, I've been in contact with a number of interlocutors overseas over the weekend, and it is not lost on them that within the United States we have a very contentious, hyper-partisan environment where each side will seek to take advantage. But as I have noted in the past, the same people who complain that the Trump administration is dealing with Russia in the past called for a reset with Russia. In the past, that called for negotiations with the Iranians, who have certainly killed more Americans than Russia in recent years. We're dealing with untrustworthy, bloodthirsty actors in Russia and Iran, but each side tends to choose their dictator of choice. In the end of the day, we've got to look past that. And Russian propaganda will exploit this fissure within the United States. It'd be easy to say ignore Russian propaganda because they're playing against us and their domestic audience. But you will often hear reporters say Vladimir Putin is boasting, et cetera, et cetera. That's part of their effort to further increase the pressures within the United States.
Hey, Norman, good to hear from you. As always, sir, the former senior U.S. intelligence official, Norman Roule there. The latest on Ukraine, the United States. I'm hopeful, call me crazy, that maybe this brings the United States and Europe closer together and doesn't push them further apart. This came from the Polish Prime Minister over the weekend. Europe awakened, Europe understanding its global potential will be America's most desirable ally. There was a recognition of a call for action, I think, over the weekend by some European officials.
Absolutely. And you already saw them come to the White House, Emmanuel Macron, Keir Starmer, before you had President Zelensky. So you do see that potentially the Europeans can offer this bridge, but Trump is going to push them to do more, which in the end might get them back into his good graces.
It's in the bond market move over in Germany. Yields are higher by 10 basis points on a 30-year bond this morning. More on that in just a moment. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President Donald Trump is getting ready to impose tariffs on Mexico, Canada, and double levies on China tomorrow. Trump had previously proposed imposing 25% tariffs on Mexico and Canada, but Commerce Secretary Howard Lutnick indicated that the figure could be lower. His remarks suggest that Mexico and Canada could make last-ditch diplomatic pushes to try to avert the measures. Israel is blocking all humanitarian aid to Gaza after the first stage of the ceasefire expired on Sunday. Both Saudi Arabia and Egypt criticized the move, saying aid should not be used as a weapon for collective punishment. Meanwhile, Hamas rejected a U.S.-led proposal to extend the truce until mid-April. Pope Francis is in stable condition in a Rome hospital. The Vatican said yesterday that the 88-year-old had a tranquil night, but his prognosis remains reserved. The Pope has been hospitalized since February 14th and has been battling pneumonia in both lungs. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. I'm next on a program approaching the tariff deadline.
We could either see a ratcheting up in tariffs, or if our trading partners want to remedy what has been unfair trade, then we could see the tariffs come off.
A conversation up next with Lori Calvasina of RBC. From New York City this morning, good morning. What a week we've got coming up. Equity futures going into it positive by 1/3% on the S&P 500. Payrolls on Friday. You'll hear from Chairman Powell as well. And a tariff deadline in the next 24 hours. Equities just about positive. Bonds lower. Yields higher at 5 basis points. The 10-year 4.2576. And the surveillance this morning approaching a tariff deadline.
There's a series of tariffs. There's March 4th, and then there's the big tariff program that's going to be outlined on April 2nd by Commerce and USTR, and that's the president's notion of reciprocal tariffs, and that's going to be very path dependent. So we could either see a ratcheting up in tariffs, or if our trading partners want to remedy what has been unfair trade, then we could see the tariffs come off.
So here's the latest this morning. President Trump is on the verge of slapping 25% tariffs on Mexico and Canada while doubling a levy against China as soon as tomorrow. Laurie Calvasina of RBC writing, our 6,600 year-end 25 S&P 500 price target has assumed we would get at least one 5 to 10% drawdown in the index. The onset of tariffs raises the risk that this kind of drawdown or something even deeper has already begun. Laurie joins us now for more. Laurie, good morning.
Good morning.
Are you witnessing the vibe shift?
We've been witnessing it for the last few weeks. I mean, we're seeing it on a bunch of different levels. Investor vibes, AAII. We've got a bunch of charts in this on our weekly today. Like, we're back to levels we saw at the financial crisis in 2022. CFTC is not that bad, but the institutional positioning in the futures market is starting to break down from record highs on every contract we track. If you look at consumer, I mean, I don't need to tell you what's been going on in the consumer sentiment surveys. And if you look at net approval as a sort of a gauge of the political vibes, and I do that because it's been tracking the S&P post-election day the same way the polling data was in 2023 and early 2024. But that is also starting to stumble, even though, to be fair, it's still, pretty strong and stronger than where it was. So we're seeing this on a lot of different levels. I would say, the corporate vibes have been a little bit more resilient based on that Conference Board CEO confidence survey. But even there, if you look at the tenor of reporting season, we've seen uncertainty really start to eclipse optimism. And if you even dig into that CEO confidence survey, employment expectations are starting to shift in a negative way. And the consumer survey is also sussing that out. So I think that we are in the middle of, kind of the early stages of a sentiment shock. That's the only way I can describe it right now.
A sentiment shock that hasn't driven a 5% correction, 10% correction just yet.
We're so on the cusp of that 5% number, and I don't consider it to really be a true pullback that does anything to significantly remove froth unless you get into that 5 to 10% range. That's sort of the first tier of fear on sort of our fear scale, which we've been talking quite a bit about the last few weeks. So we're getting close, to sort of being in that technical pullback period, but we're just not even there yet. Unbelievably, I have never seen the AAII survey collapse like this without a big move lower in stock prices.
One of the reasons why is because consumer confidence, or at least confidence among CEOs, has continued to remain strong. What has your takeaway been from some of the earnings call and the guidance or lack thereof from CEOs?
Yeah, I mean, it's interesting. I haven't crunched the numbers for February yet, but through January, at least, we had not seen a big spike in either downward guidance or upward guidance. And if you went back to last year in the calendar first quarter, there was a big spike in downward guidance. So companies at least were trying to keep the bar low. I don't think that companies know where to put the bar right now. It's interesting that Conference Board CEO confidence survey, it was looking at late January, early February versus last fall. It wasn't telling the cadence of sort of all the weeks, sort of January versus where we are now. And I do think, just based on what I've reading, that I have seen that optimism coming down week to week. And it seemed like as we were reading in reporting season, every week was worse than the one before.
There's a real question about how the market responds tomorrow if tariffs do get put on Mexico, Canada, and China. How offsides would this equity market be if those tariffs were to get implemented as stated?
So we have been hearing, for I would say the past month plus, the idea that tariffs are just a negotiating tactic and that you're not going to see anything significant or meaningful in a long-lasting way, like maybe you get a few weeks, but you're not going to get anything with any duration. I've been hearing that for weeks. If I think back, though, to my marketing last week, and I was talking to U.S.-focused investors, I finally started to hear for the first time the idea that this tariff as a negotiating tool is too consensus. And so I was really starting to finally see last week U.S. investors question whether or not there was wisdom in that consensus and starting to come to terms with the idea. And I think that's driven us to that kind of 4.6, 4.3%, dip.
So you think that the dip that we've seen so far is on basically hedging that there could be these tariffs that are implemented. How much more downside do you think that there would be?
So if you think about a big shopping mall, right? And you're at the top of the shopping mall, you have to take the escalators down. You kind of get to one level, you look around, and then you decide if you're going to keep going back down. I think that's how I think about these different tiers of fear in equity markets. So 5 to 10%, again, is sort of a garden variety pullback. We have had plenty of those since 2022. What I've noticed is that when you get to sort of that 8, 9-ish% type mark, that's when you really start to see true fear come in. One of my valuation models suggests if we have sticky inflation, 10-year yields at 3.5%, and a couple Fed cuts, 5,600 is a reasonable estimate of where the S&P should end up the year. That's close to that 10% mark. So I think that's the first battleground. After that, you have to go back to pre-COVID, post-GFC, I think, to get a good read. If you look at the 2010, 2011, 15, 16, 18 periods, we saw declines of 14 to 20% in the equity market. These were periods where economic recession was truly feared, did not end up being manifest, or some sort of systemic issue. So think U.S. debt downgrade, European sovereign debt crisis in 2018. We had the trade war. We had Fed concerns on the balance sheet. And 15-16 was the industrial recession that didn't spread because of consumer resilience. I think the risks of that second tier of fear are rising. After that, tier 3 would be a recession or a war. Tier 4 is a major crisis. Tier 3 is, like 25 to 30%. Historically, major crises tend to be worth about 50%. I don't think we're looking at tier 3 or tier 4, but I do think that kind of 14 to 20% risk is rising. Not my base case, but that would be sort of the next level.
Trade is global. So if things turn challenging, it's going to happen everywhere. Do you think the U.S. is the most prepared?
I think that the U.S. companies, and I give them credit for that. And when I look at that CEO confidence survey, they have been through a heck of a lot in recent years. And really post-GFC, they have refined their crisis management skills. We saw that come through during the SVB crisis, right? And you heard companies really talk about that. Even in the 2018 trade war, while we still had that 20% peak to trough drawdown in the back part of that year, they ended up managing through that pretty well, and we didn't have a massive hit to earnings. So I do think that we get some resilience there, but I do think, we're sitting in the U.S. at valuations that have hit ceilings, and they're starting to sort of retreat. We have seen various, the vibes we've talked about weakening. CFTC positioning data hit a brand new high late last year, just like it did in 2018. So we're not in a great position in terms of positioning and valuation in the U.S., and that I think that has started to make some of this rotation out of U.S. equities into European equities start.
Thinking about what happened back in 2018, just when does the Trump put actually kick in?
Well, I think 2018 has been a great example in that, there's sort of this view, right? And I don't completely disagree with this view, right? Because I do see 55, 5600 as a battleground for other reasons. But, I've been hearing all year, in addition to tariffs are never really going to happen, the idea they're not going to let the market go down that much. Well, I'll tell you what, John, I was starting to hear that question last week as well, right? And some of the investors, and again, I talk mostly to equity folks, but they're like, well, maybe they're just focused on the bond market, and maybe the bond market is the put. I have been bringing up, though, 2018 all along as an example of when economic growth concerns come on the table, things may not be entirely under your control, no matter how much you would like to control them. And that's what we really saw was fear of the balance sheet unwind, too many hikes, kind of the idea that the Fed wasn't listening to markets and watching the economy properly, intersected with the unknowns of the paradigm shift from the trade war. And what we saw in September of 2018, and I remember this crystal clear, I was sitting at our industrial conference in Las Vegas, and I heard companies come into the conference rooms and say, these tariffs are going to have ramifications. And up until that point, the idea that the U.S. would be immune, you wanted to buy the USA, sell the rest of the world, we could manage through, yada, yada, yada. It just completely fell apart. And you blink an eye and you get a 20% drawdown.
There was a wake-up call pretty quickly, that's for sure. Laurie, appreciate your time, as always. Laurie Calvasina there of RBC. A big week coming up. Strong finish to last week, strong rally into the weekend. Not enough to erase a weekly decline. 2 weeks of losses on the S&P 500. Equity futures this morning up by 0.4%. On the Nasdaq 100, higher by 0.5%. In the bond market, what a run. We've added it up for you every single week, week on week. 10-year bond yields in America down for 7 consecutive weeks, the longest run since June 2019. A small bounce this morning in the context of a much bigger rally in the bond market. Yields are higher by just 5 basis points on a 10-year, 425.76. And last week, the drop of 22 basis points, the biggest weekly drop of the year so far.
So this should be a good thing for risk assets, right? This is what people were hoping for. This is what the Trump administration has been desiring and targeting. Not so much. This is coming on the heels of some growth concerns as well. And I wonder how much this market increasingly is skewed toward downward moves in the 10-year being a negative tell on the U.S. economy and not necessarily really parlaying into that risk-on type of feel.
At the epicenter of the bond market moves worldwide, not the Treasury market this morning, but the bond market. Check out Europe. The German 10-year higher by almost 10 basis points, up 11 on a 30-year maturity. In the FX market, off the back of that, the euro stronger by 0.75%, 104.51. From Reuters over the weekend, economists advising the parties that will likely form a new government in Germany. They estimate around 400 billion euros are needed for the defence fund, 400 billion to 500 billion euros for the infrastructure fund.
So what I'm actually looking for is some sort of prediction of what this would mean if markets were taking this truly seriously. Right now, there's sort of a handicapping going on in markets. But George Saravelos of Deutsche Bank came out and said there are too many cross currents right now to hold any kind of conviction call on euro dollar. They are backing away from their short euro call. I am curious how far 10-year yields in Germany would have to climb if people truly believed they were about to borrow $1 trillion for defense and infrastructure spending.
That would be a monster shift, not just for Europe, for Germany, but for the world and a global bond market for that matter as well. On our radar this morning, European leaders considering a 200 billion euro boost to defence spending, a summit over the weekend looking to shore up support for Ukraine in the aftermath of President Zelensky's meeting with President Trump.
So what I see right now, reading between all of these meetings, between the blow-up on Friday and what happened in Europe over the weekend, is one key fact that they do not agree upon on both sides of the Atlantic, which is that Trump says he does not want to talk about security agreements until there is a ceasefire and peace, until they get to the negotiating table. Ursula von der Leyen left that meeting over the weekend and said, we need to talk about security agreements now to give Ukraine an upper hand at the negotiating table. So when it comes to the security agreement, Europe and the United States are not aligned.
That said, where's the leverage? And I keep asking this because ultimately any deal needs the U.S. backstop. And then on the flip side, you have Europe, at least you've got the U.K. and France trying to put together some sort of deal with Ukraine to present to Putin themselves and get some sort of dialogue just going so that they can bypass the United States. It's a really interesting dance. I am very curious how this ends up and potentially what this means for U.S. membership in NATO and the ongoing cries. We saw Elon Musk's tweet over the weekend. Very interesting moment between the cross-Atlantic relationship.
I would say two things on NATO. Trump has not changed his position, and actually you've seen other presidents like President Barack Obama, President Joe Biden talk about the fact that Europe needs to do more. They have outsourced their defense to the United States, and it's not enough. They have to start reaching these defense targets. Now Trump is going to push it even more. They're talking about, over the summer before the election, 5%. They want to see that spending to GDP when it comes to Europe. But Mark Rutte said to reporters leaving, and I mentioned this earlier, but I think it's a fantastic quote, let's stop the gossiping about what the U.S. might or might not do. They're in NATO. They're committed to NATO. And at the moment, I'm taking his word for it.
How many times did you watch that exchange Friday afternoon?
Probably about 6.
What do you think broke things down?
Honestly, my personal opinion, which nobody really wants, but it seems like there's a lot of animosity heading into this meeting that was personal on a couple of sides. It felt like that from the body language. It seemed like Donald Trump was trying, although irritated about the lack of suit. And J.D. Vance, I think his involvement and the fact that in the past these two men, J.D. Vance and Volodymyr Zelensky, have had bad blood, his involvement seemed to ignite an unstoppable need to respond.
I was surprised by a lot of things, but I think one of the biggest surprises that I had, because these things happen behind closed doors as well. And there was reporting from a couple of years ago that President Biden got very frustrated on the phone with President Zelensky as well, behind closed doors. It's the first time we've seen this kind of thing on TV, so everyone's shocked. I was more surprised that Zelensky allowed this to happen in English, when he's been so careful with some of the interviews he's done, including the one with you, where he chose to conduct the interview in Ukrainian. And if you saw the interview that he put on later on with Fox News, later on that afternoon, he had a translator that he had to pause mid-interview, live on TV, and get clarification as to what the interviewer was actually asking him. You didn't see any of that in this meeting at all. And I wonder how much was actually lost in translation in that moment, because if you saw him subsequently over the weekend, speaking to the British and European press, everything was in Ukrainian. You know behind closed doors how long they take when they have a bilateral meeting to choose very specific words and make sure that everyone understands where we are. That was not the moment to be engaging in English in the moment in front of the American media in the way that things transpired.
When you sit down with Zelensky, and I did over the summer, if you're asking something where he feels confident enough to talk about in English, he will. But for the most part, especially if something is controversial or he wants to be very precise with his words, he decides to make sure he's answering in Ukrainian so he can make sure he has a bigger vocabulary. He also looks off to the side all the time to make sure he's talking to his team, to make sure that he understands the meaning of the word being spoken in English. One thing I was really struck by the fact, never once did he decide to just speak in Ukrainian to get a point across. They almost got through this meeting 40 minutes in when he decided to say to J.D. Vance, can I comment on that? And that was the moment where things really took a downward spiral.
Things broke down pretty quickly from there. One more question. Wasn't one more question, was it? Things unraveled pretty quickly. Equity futures this morning, positive by 1/3%. Tomorrow, the only thing that's going to matter is this deadline right here. The United States set to double the tariff rate on China to 20%, going into effect tomorrow. Chinese state media reporting the country is weighing retaliatory measures on U.S. agriculture and fruit products, with President Xi preparing to unveil a stimulus plan later on this week. It's amazing that we've got these other tariffs elsewhere, 25% Canada, Mexico, that's taking all the attention away from the fact that we're probably going to get, in the minds of many people on Wall Street, an additional 10% tariff on China.
Absolutely. When I speak to officials, and I've been talking to them throughout the entire weekend, basically, try to understand where we are in these negotiations, no one's talking about China because everyone just pretty much assumes the tariffs are going through when it comes to China. I am reminded, though, at Goldman Sachs' note over the summer, and they were totally right when it comes to stimulus out of China. They were waiting for the bazooka to see what Trump was going to do when it comes to trade, and they were absolutely right. We're at 25%, and additional to already what is in place when it comes to Chinese imports.
Our next story is on our radar. I'm not sure if it's on anyone else's, given the news elsewhere, but we should be talking about this. President Trump announcing plans for a U.S. strategic crypto reserve set to include undetermined amounts of major tokens. The announcement sending cryptocurrency prices soaring, recouping some losses from the asset class's worst month since 2022.
I actually think this is a big deal.
Agreed.
I actually think that we should be talking more about this, including tokens like XRP, Sol, and ADA, which are less mainstream than, say, Bitcoin and Tether. It has actually ignited the ire of people within the crypto universe who don't want the legitimacy placed on these. And let's just put into perspective that the only country that has really engaged with this type of crypto experiment has been El Salvador, and it did not end well. And I am just wondering, at what point, to what end, is this coming on now? It's not like there isn't other things to talk about.
The explanation that I'm waiting for is why the issuer of the reserve currency requires a strategic reserve of cryptocurrencies. Can you make sense of that? I can't make sense of that. The other issue I have with this as well, and I think a lot of conservatives would have issue with this too, is this is not a good use of taxpayers' money in the mind of a lot of taxpayers that have supported the Republican cause. And I wonder how much noise is made about that in the coming days and weeks.
This is a speculative asset class, and some people would argue, probably in the Trump camp, that if there is massive upside, well, the taxpayers get that. At the same time, is this really a prudent use when we're worried about every single dollar and at a time where there's incredible volatility? And we've seen those losses since the inauguration.
We're seeing that rally this morning off the back of some of those headlines. Let's turn to this story. A tariff deadline fewer than 24 hours away. Tobin Marcus of Wolfe Research writing, if Trump follows through with his threats, it increases the risk that he'll go big with his April 2nd reciprocal tariff policy. Tobin joined us now for more. Tobin, I guess the first question, will the president follow through on his threats?
In some ways, the setup looks exactly the same as it did in early February, when I was fairly confident that he wouldn't end up following through, and at least not doing so with long duration. I have to say I'm less optimistic this time. I think he's been, quite resolute that he's going to do something. Even over the weekend, the comments from Commerce Secretary Lutnick that people are taking encouragement from, pointed to some flexibility in the rate, but still, kind of double down on the likelihood that they would go ahead and do something. So it's hard to have total confidence, but, I think it's also impossible to write off the risk that he'll actually go through with it.
Scott Bessent, the Treasury Secretary Tobin, said to David Weston on Bloomberg TV on Friday that the Mexican government made a proposal matching U.S. on China tariffs and then said it would be a nice gesture if the Canadians did it also. Is that a big enough concession to potentially put another pause on these 25% tariffs?
Conceivably, the tariffs have never really made a lot of economic sense for the U.S. In the Canadian case in particular, they are way out of scale with the actual problem that we have in terms of migration and drug trafficking, which is obviously much more of a Mexico problem than a Canada problem. So, it all comes down to Trump's assessment, I think, of whether or not he's kind of accomplished his political goal here. In the Mexican case, again, there is much more in the way of actual policy cooperation that we need. There have been some indications that they're making progress in terms of cracking down on some of the cartels. So if he wants to, he certainly, I think, can do what he did last time and just point to progress made and new commitments and call it off. The question is what he wants to do.
Tobin, one of the tariffs is going to be a 10%. Basically, the Trump administration signaling that they understand how important Canadian heavy crude is, especially to the Midwest. But the Canadians are also saying they could maybe have reciprocal tariffs on energy. How ugly can this get?
It could get very ugly. I mean, the initial executive order imposing these tariffs back on February 1st made very clear that the United States reserves the right to further escalate if there is retaliation. And I think that the sensible expectation would be that there will be retaliation because the Canadians and the Mexicans can't just take this sitting down. So, I think there absolutely is upside to the rates if things go really badly. I think we saw, as you were just talking about in the confrontation with Zelensky last week, when things get personal, I do think there's a risk that things can go south in ways that don't totally line up with either side's objective interests.
Wait, Tobin, can you develop that, please? This idea that actually what happened on Friday will influence the likelihood that these tariffs go on tomorrow?
I don't know that there's a direct influence. I think it's more just a case study. As Trump himself said in the Truth Social post that he put out afterwards, it's telling what can come out under emotion. If there is an actual move to go forward with these tariffs, even at a reduced rate, like the likelihood of tit for tat retaliation is definitely something that we need to worry about. And if we're locked into a confrontational stance with these two countries, you can't rule out the possibility that, sort of interpersonally things go wrong and we find both sides kind of backed into their corners.
Tobin, tomorrow we also have a joint address to Congress from the President of the United States, which basically is a different way of saying we're going to have a State of the Union. What are you expecting?
Yeah, they've done very little in terms of previewing, even talking to Republican sources on the Hill. There's not a lot of rumors and gossip going around about what it is that he might announce. My guess would be that it's mostly focused on accomplishments and that we have kind of a promises made, promises kept theme where he points to the massive amount of activity that's already gone on, much of which they feel very good about. I'm sure they'll have some, tidbits of news. It would be uncharacteristic to go into this and have nothing that's new and headline grabbing. But I think a lot of it is going to be, rehearsing and framing up the totality of what they've done so far.
Hey, Tobin, appreciate your time as always, sir. Thank you, Tobin Marcus of Wolfe Research. Things could look very different tomorrow on the trade front, that's for sure. Let's get you an update on news elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Ukrainian President Volodymyr Zelensky said that he's willing to meet with U.S. President Donald Trump if he's invited again. Zelensky said he wants to solve real problems, adding that Ukraine is ready to accept a minerals deal with the U.S., which was put on hold last week. Elsewhere, DeepSeek says its theoretical profit margin could be more than 5 times its cost. The startup revealed that it saw a 545% profit margin for its V3 and R1 models during a 24-hour period, but it added a disclaimer that its actual revenues are substantially lower due to factors like only some services being monetized and discounts during off-peak hours. Prada is said to be moving closer for a deal to buy Versace, agreeing to a price of nearly 1.6 billion euros. Sources say talks with Capri are progressing after initial due diligence didn't find any risks, and the deal could be finalized in March. An acquisition would allow Prada to create a larger Italian player to compete with luxury rivals LVMH and Kering. And that's your brief, John.
Danny, thank you. Remember the snoozy Biden years? That would have been a top story.
Would have been a top story. Yeah, Forza Italia. They're basically, this could be the answer to Kering and LVMH out of Milan.
Anti-competitive issues, entry-level handbags and all that stuff.
Yeah, sort of mid-level and high-level luxury.
It's a very different time. Up next on the program, risk on the horizon.
Today, what is the risk is that if you look out over the horizon, in an environment where policies are likely to be inflationary, I think there's going to be demand destruction.
Up next on the program, Ajay, Rajadhyaksha of Barclays from New York City. This is Bloomberg. sound like a broken record, but what an interesting time for financial markets worldwide. In Germany, bonds are down and yields are higher on the expectation of more spending on defence, on infrastructure. Stateside, yields are dragged higher too by 4 or 5 basis points on a 10-year, 4.25. Last week, a second week of losses, but a strong rally into the weekend and some positive follow-through. On the S&P 500, higher by a third of 1%. Under surveillance this morning, risk on the horizon.
We have, as I mentioned, preemptive inflation anxiety. There is much more anxiety anticipating the shocks from higher prices today. What is the risk is that if you look out over the horizon, in an environment where policies are likely to be inflationary, we have consumers that are seeing a lot of prices and paying close attention to all of these prices. And as a result, they're pulling back on demand. I think there's going to be demand destruction.
So here's the latest this morning. Investors bracing for the February payrolls report due on Friday after a slew of soft economic data. Ajay Rajadhyaksha of Barclays writing, if the drumbeat of negative news picks up, including in the payrolls print, investors will have to take a scenario that seemed unlikely at the time of the election. Seriously. Could the US economy, under a Trump administration, be headed for a recession over the next few quarters? Ajay joins us now for more. Ajay, good morning to you, sir.
Good morning.
OK, so it's not your base case, but the odds aren't zero. And have the odds just gone up?
They have gone up. I mean, it's not something that I would have said it's extremely unlikely 2-3 months ago. But a couple of things have all come together. The first is the president seems to be far more serious about tariffs than, was consensus in November when he won. And the second is we have had a slew of weaker data in the United States in the last 2 or 3 weeks. Personal consumption's slowed down, income slowed down, retail sales were weaker. The Atlanta Fed's GDP tracker has a negative 1.5% for this quarter. That's overstating it, but things are starting to move in the wrong direction.
If he's far more serious about tariffs, is he far less sensitive to declining equity markets?
It seems that way. You notice this time around, as opposed to his first term, the president's really not referenced the equity markets at all. Even 2 weeks ago, when we are near an all-time high. So what they seem to be talking about is the 10-year treasury rate, getting interest rates lower, getting the dollar weaker. So they might have moved the guidelines. I don't know. I don't think anyone does. This is a president who is somewhat mercurial, who keeps changing his mind from time to time. But for now, yes, you're right. It does seem like the equity market, the Trump put, if you will, on the equity market still seems quite far away.
There is a consensus right now that the U.S. economy has so much momentum and so much strength that it would take such a massive number of shocks to really send it into full-blown recession, which is the reason why people are basically discounting that. What would have to go wrong? You mentioned this.
A lot of things altogether. I completely agree with you. The single biggest tailwind behind the U.S. is the U.S. consumer. And the reason that the consumer has tailwind is just because wealth has gone up so much. Household wealth is up over $50 trillion over the last 4 years. I mean, these are just very large numbers. And so you know what the US consumer is doing? He's spending every single dollar he takes in. But if equities first pull back 15, 20%, then I think that starts to fade. If those job cuts kick in, you are right. You would need a lot of things to all go wrong simultaneously. I don't think it'll happen. But the odds are a little higher than before.
So then put into perspective the idea that we're seeing the economic surprise index run by Citi roll over to the lowest, to the most negative going back to September. The fact that we are seeing an increasing number of sort of tepid economic signals. Do you discount that as normalization? Or at what point do you see that as something of a weakening trend?
No, I think it is a weakening trend. I just don't think right now it is anywhere close enough to get you to a recession. You would need one final shoe to drop, which is these job cuts that the government is doing. Last year, for example, the US economy created 2 million jobs. If we actually let go of close to 1 million people, government, related to government, et cetera, that takes away 50%. If the equity markets fall simultaneously by, say, 15, 20%, together, that would get you uncomfortably close to a recession.
Do we see those DOGE job cuts in the federal government show up in Friday's payrolls report?
No. So the survey week was before these started. And remember, it'll take time. So last year, the US government hired net 50,000 people at federal level. But about 130 to 140,000 people left voluntarily, and those were replaced. If you don't do both, then that itself is about 200,000 jobs going away. And then there's about 200,000 people on the government payrolls who are below 1 year in service, which means it makes them easier to let them go. They're probationary. You hit those, that's 400,000. Pretty soon the numbers start adding up, but no, it'll take time.
So you think tariffs and DOGE are drags right now, but what about the good potential policies we could see out of this administration, like tax cuts? Do those need to be brought forward to balance the market better?
In an ideal world, probably, but I'll direct your attention to the House budget resolution. Now, this is a little complicated, but if things don't change at all, if status quo persists, if we just extend the tax cuts, 12 months from now, you don't get a new tax cut, that itself will add about $4 trillion to our deficits over the next decade. What the House is aiming for is to add $2.8 trillion in deficits, if you look at the budget resolution. And the numbers are the numbers. Beyond the point, they cannot be fudged. So right now, the most that Congress is trying for is a mild fiscal drag over the next 10 years, because I don't think they have the votes for large new tax cuts.
Does this mean that on some level, especially if this is an administration that's targeting a lower 10-year yield, there needs to be slower growth on an ongoing basis to finance a deficit that seems much more structural in the United States?
You have to be careful about that, because growth slows down too much, and you know what happens? Tax receipts fall out of bed. Doesn't improve your deficits. So I don't know that is something that, I mean, look, no administration is going to say that we want much weaker growth, because, look, that gets your mortgage rates down. No one in their right mind is going to say that. I don't think the administration is especially trying for that either. It's just that they are no longer focused on the equity markets as a sign of success.
How brutal are the arguments at Barclays right now with Venue at 6,600? Are you fighting yet? You don't sound bullish at all.
I'm going to have a conversation with him. Let's put it like that.
Have you had that conversation yet?
To be fair to him, data has shifted a lot in the last 3 weeks.
Yeah.
Part of it is, 2 months ago, if you had told me that we are going to impose 25% tariffs, and then you would have said on Canada, that would not have seemed realistic. And yet here we are, a couple of days away. So the facts on the ground have shifted. And if that, to quote Keynes, then our views might shift.
Things have changed. We'll look for an update from Venue maybe in the next couple of weeks. Ajay, it's good to see you.
Likewise.
Thank you, sir. The latest from Barclays, contentious at the end there.
Are you trying to create some sort of
trying
animosity?
To start fights at Barclays.
Yeah, exactly.
They've got a 600 price target.
I know, and well, for now, and we'll see what happens, and we'll see what kind of messages come out from Venue. I stand by it. What are we talking about? We'll see about
Things have changed, and if we get 25% tariffs on Mexico, on Canada, then things have really changed.
Well, that's what Laura Calvasina was saying. There are these tiers of sell-offs, and she's seeing a greater likelihood of a much more significant sell-off should some of these things come to pass, like the tariffs on Tuesday.
The second hour of Bloomberg Surveillance up next. We'll catch up with Mohamed, El-Erian of Queen's College, Cambridge, Michael Zezas of Morgan Stanley, Chris Harvey of Wells Fargo, Mark McCormick of TD from New York City. You're watching Bloomberg TV.
More that we have the risk that we will both have higher prices and less sales, the more markets should be preparing themselves for the risk that a stagflationary scenario might be playing out.
I'm not that worried about inflation, and your famous last words.
There are concerns, and there should be concerns about longer-term structural inflation.
The Federal Reserve is clearly in wait-and-see mode.
Unfortunately, I think the Fed is going to be too reactionary in this environment, and that is always going to be too late in this environment.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now. Let's start with the scores. Equity futures on the S&P 500 positive by 0.4%. A strong end to last week going into the weekend, and some positive follow-through on the Nasdaq 100, higher by 0.5. Your week ahead is absolutely packed. On Friday, the payrolls report, and you hear from Chairman Powell. In between, lots of economic data and an address from the President of the United States to a joint Congress, but also later in the next 24 hours, a tariff deadline for Mexico, for Canada, for China.
And just how offsides is this market should these tariffs go on the docket? A lot of people talking about this as a negotiating tool. Even members of Trump's administration talk about these as negotiating tools. And yet, Lori Calvasina said an increasing number of clients have been asking her about it and are saying maybe they're not taking it seriously enough. and maybe they're going to be offsides when it comes to market valuations.
The Treasury Secretary on Friday said if Trump's favorite word is tariffs, his second favorite word is reciprocal. So you can see the direction of travel when it comes to how they are negotiating, especially when it comes to those April 1st, April 2nd tariffs. When it comes to Canada and Mexico, it's a little bit hard to understand where they're going because Howard Lutnick yesterday, the Commerce Secretary, said two interesting things. Fluid situation. Well, what does that mean? Things are changing. They could change. But then he also said there are going to be tariffs on Tuesday on Mexico and Canada. Exactly what they are, we're going to leave that for the president and his team, which, by the way, Howard Lutnick is part of that team, to negotiate. So it sounds like they're going on, but maybe they're just going to be a little bit less.
Throw Europe into the mix as well. Some big moves over in Germany. In the debt market, Bunds lower, yields higher, up 10 basis points on a German 10-year. And in the defense stocks, in that sector right now, you're seeing a monster rally on Rheinmetall, on BAE Systems. It looks like that rupture in the Oval Office, that diplomatic breakdown on Friday, could spark a big change in Europe.
Yeah, maybe that's the kick in the pants to actually get them to spend on their defense spending. You mentioned the Reuters report earlier that came out over the weekend with something to the tune of close to €1 trillion in spending from Germany, from the joint European Union as a result of needs to beef up defense spending as well as infrastructure. A question of whether this is realistic, given the appetite, given the lack of political leadership right now in Europe. At the same time, people are taking it seriously enough that you're seeing moves in the market. And I wonder if this actually could boost some of the outlook for growth. ECB meeting on Thursday. That could be actually really interesting.
This is exactly what the President of the United States would like to see. These kind of outcomes. I'm not sure if that was the objective in the way the meeting went on Friday, but certainly this is what he'd like to see.
Absolutely. He doesn't want to see a Europe that continues to rely on the United States when it comes to defense. The administration wants to see Europe step up. By the way, that is bipartisan. We saw the same rhetoric from Joe Biden as well, but a little bit more forceful from Trump in 1.0 and now in 2.0. This is exactly what he wants to see. It's also going to be what's needed if there's going to be a peace deal when it comes to Ukraine.
If you are just joining us, welcome to the program. Equity futures here positive by 0.5%. A lift in the equity market. Bond yields a little bit higher. The euro stronger as well, and lots to talk about on the continent in just a moment. Coming up this hour, we'll catch up with Mohamed El-Erian of Queen's College, Cambridge, as investors brace for a busy week ahead. Chris Harvey of Wells Fargo on the perfect storm against momentum stocks, and Mark McCormick of TD as Secretary Besson pitches Fortress North America. We begin this hour with Stock Steady as investors prepare for a week full of event risk. Mohamed El-Erian of Queen's College, Cambridge, writing a heavy data week on tap for the US with a monthly jobs report, lots of speaking engagements for policymakers, including Treasury Secretary Besson and Fed Chair Jay Powell, and the latest on tariffs and Doge. Mohamed joins us now for more. Mohamed, welcome to the programme, sir. Where to begin? I think we start on Friday and the rupture in transatlantic relations and the breakdown in the Oval Office. When you saw that and when you think about the consequences it could have for the economic picture in Europe, for military spending and for what it could mean for financial markets too, Mohamed, what are your thoughts at the moment?
Thanks for having me, John. My thoughts is that feeds into some existing themes, both top-down and bottom-up, and intensifies them. So top-down, we've had issues of fiscal realignment, and that's going to feed into fiscal realignment, including putting pressure on the debt brake in Germany, including the question of how does it interact with what Doge is doing in the US. Secondly, it feeds into the energy market and how we think about the energy market. And third, it feeds into the realignment of the global order that also has a trade element to it and a currency element to it. So you have all these top-down factors that are being amplified. And then the bottom-up factor that's being amplified is defense. And we are seeing significant sector differences occurring, as you would expect. So I think of it, John, not as unprecedented, which are the words that the political science and the international relations people are using, but in the field of economics and finance, it is amplifying things that were there already.
So, Mohamed, a number of weeks ago, we said on this programme that the President of the United States may well push the Europeans into doing things that might be good for them. You wrote in the Financial Times about a month ago, the mounting risk to US exceptionalism. How does some of these things across these dimensions play into what you wrote about a month ago?
So, John, both the good news and the bad news is we have a very action-oriented administration, has come in, it has hit the ground running, if not sprinting. And if you are a business, it feels like you're trying to drink from a fire hose. There's energy issues, there's immigration issues, there are trade issues, there are public sector issues, including public sector contract, there are regulation issues. So you're trying to absorb all this. And what we've seen is sentiment has come down and there's been a wait and see attitude, because most of these things impact both your income and your expenditure. So it's really hard to figure out how all these things are going to play out. Then there is the international relations side of it, your trading side of it. So the worry that I have is that the lack of ability by the public sector to absorb all this results in a wait-and-see attitude. That wait-and-see attitude comes at a time when we already have a bit of a whiff of stagflation going on. And next thing you know, people start questioning U.S. economic exceptionalism. And if they do, two things happen. You start questioning the only reliable engine of growth for the global economy, and you start questioning the shield that markets have had against all sorts of geopolitical and political aspects.
That's a lot of hair on the American exceptionalism story, and we've been talking to people about it for the past couple of weeks, about the concerns, the lack of certainty, the on-hold kind of nature of a lot of CEOs. And yet, when you ask them, they still say they prefer to invest in the U.S. over the rest of the world. If Europe went through with a 900 billion euro spending package on defense and infrastructure, would that shift for you? Would you see brighter shoots in Europe?
No, it wouldn't shift for me. I would still prefer the U.S. over Europe for the simple reason that Europe doesn't have a genuine and durable growth engine. So maybe defense contributes in the short term to growth, but they need to get a handle on some really fundamental things. I encourage everybody to read the Draghi report. The Draghi report is a really good assessment of what has gone wrong in terms of investment, in terms of competitiveness and productivity, and what needs to go right. And that should be your benchmark when you assess future growth prospects in Europe.
So what happens, Mohamed, if this American exceptionalism story is challenged to the degree that you're laying out, and a lot of people are worried about, but there isn't a brighter alternative in Europe?
That's the concern, because remember, I've always said the good and the bad and the ugly of the global economy. The good is the US, the bad is China, and the ugly is Europe. And if you don't see China and Europe converge up to the US, there's a risk that the US will converge down to the other two. It is a risk scenario. It is not the baseline, I want to stress. But in mid-January, no one was questioning US economic exceptionalism. And now, as you point out, a lot more people are starting to worry about it.
Mohamed, what do you make of the tariffs? Do you think they're actually going to come on tomorrow? Or do you think the market consensus of that maybe China, of course, goes on, but there will be a pause, another pause or a pass when it comes to Canada and Mexico is the accurate way to view this?
I don't know, Annmarie. I really don't know. I don't think anybody knows but the president. But what has become clear is that there are three sets of tariffs. And that explains why the president was pursuing so many objectives with tariffs. You know, when he came out in October, when he said it's my favorite word, he said it can raise revenue, it can result in fairer trade, it can put pressure on both adversaries and allies, and in addition, it can protect U.S. industry. And the initial reaction of the economists was too many objectives for a single tool. But we're seeing now what is happening. You have a set of general tariffs that do the revenue side and the reciprocity side, the fair trade side. You have a set of sector-specific tariff, aluminum, steel, that protect industry. And then you have a third set of tariffs aimed at particular countries to get particular outcomes. And I think that that's the thing we're going to live with for the next few months, if not next few years, which is multifaceted trade policy.
Mohamed, for the first time in a long time, there was a Fed official in the last week that considered stagflation. I'm sure you noticed the same comments. Downside risk to growth and upside risk to inflation. If we were to have a Fed's dual mandate that went into conflict, how do you suppose would be the best way to approach that situation?
It's tough. It's really tough. Stagflation is the nightmare of policymakers, and it is the nightmare of a Fed with a dual mandate, as you point out. So it's really tough. I worry, like you had in the introduction, that we've had a reactionary Fed. So the Fed is not going to be getting ahead of this anytime soon. I hope it understands it, but it's not going to be getting ahead of it anytime soon. So the risk is, John, that monetary policy continues to amplify volatility rather than acting as an anchor of stability. That's the risk we face right now.
Mohamed, can you just give us a sense of the trajectory of your belief that the economy can withstand all of this in the United States as the year has progressed? And I realize that it's the beginning of March, but how much more worried are you now than, say, 2 weeks ago about a real calling into question of American exceptionalism and a real rolling over of the U.S. economy?
You know, it's my nature. I've been worried for a while. I put out an FT op-ed on February 14th, saying be careful that slowly we may see the erosion of U.S. economic exceptionalism, and that's bad news for everybody, not just the U.S., for everybody. So I've been worried for a while, and I've seen sort of three elements that have made me worry. One is the way business is reacting to all these policy changes, which increasingly is wait and see. We think it's going to be fine, but let's wait and see. Second, we know that the lower segments of the household income distribution is under enormous pressure, and that has been a concern for a while. And then the third issue is the risk of a Fed policy mistake. So these things have been there, and now they've amplified because of what's been going on.
Mohamed, always appreciate your time. You're a good friend of this programme, a good friend of ours. We appreciate it. Thank you, sir. Mohamed El-Erian of Queen's College, Cambridge there on some of the challenges for officials worldwide and for global markets as well. Speaking of the challenges for officials, let's talk about Europe. A reality check for defence spending, one that they've woken up to. The next stop potentially is a reality check for the push for net zero and some of the issues that we've had on the continent for a long, long time and how expensive this transition actually is. This from the EU just moments ago. To grant car makers leeway in reaching 2025 CO2 targets, is this the next reality check for the Europeans?
That they have to unravel so many layers of regulation and policies to even get down to something that is pro-growth, that it becomes something that is so onerous they cannot respond with the aliveness that so many people were hoping for.
And how much does Ursula von der Leyen, she's speaking right now, need to give to the auto industry if they are facing potentially a harder market when it comes to dealing with the United States? They're going to need to use some other levers to make it acceptable and easier for autos to produce and thrive on the continent.
They've been crushing their own economies and killing their own businesses. And we've seen that repeatedly. Talked to Guy Johnson a few times about this in the past, how expensive it is to start a business in Germany because of what? The cost of energy. It's a major part of this story.
So you put all these things together, including ossified policies that have been in place for decades. How do you get to a pro-growth place? We're talking about potentially car makers getting leeway to reaching 2025 CO2 targets at a time when they also need something to generate growth to compete with China.
For decades, Germany was able to produce and have a manufacturing base as good as they had it because of the cheap Russian energy they were importing. Once that shifted, you can tell they were really out of alignment in terms of their manufacturing base and how much more costly it was to produce these products. And they're basically have to recognize all of this now.
We're hearing from Germany's election winner. The United States is putting enormous pressure on Europe to act. We should seek a defence deal before Thursday's EU summit. Those headlines crossing just moments ago. Equity futures right now in the S&P positive by 0.6% with an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Elsewhere in Europe, France and Britain are proposing a partial one-month truce between Ukraine and Russia. That, according to President Emmanuel Macron and his foreign minister. The agreement would cover air, sea, and energy infrastructure attacks, but it would not include ground fighting. The comments come after President Zelensky's unsuccessful meeting with President Trump at the White House on Friday. China's ambassador to Australia is warning that a decision to ban AI app DeepSeek from government systems and devices risks trade and technology ties. The ban was implemented by Australia's government in early February, citing national security. The ambassador's comments came as a Chinese naval task force continued to skirt Australia's territorial waters. Enora, a drama about a sex worker who marries the son of a Russian oligarch, won Best Picture at the Academy Awards. Filmmaker Sean Baker won for directing, film editing, and Best Original Screenplay. And Mikey Madison won Best Actress for her starring role. Adrian Brody was named top actor for his role in The Brutalist. And that's your brief. John.
Penny, thank you. And I haven't watched any of those movies. Have you?
I have not watched any of those movies either. And to be honest, last night I was looking at markets, so.
Could not care less about the Oscars anymore. All right, up next on the program, facing the tariff deadline.
There are going to be tariffs on Tuesday on Mexico and Canada. Exactly what they're going to be, I'm going to leave that for the president to decide.
Zezas of Morgan Stanley joins us next from New York. This is Bloomberg. This session highs here on the equity market on the S&P 500, positive by 0.5%. Under surveillance this morning, facing the tariff deadline.
There are going to be tariffs on Tuesday on Mexico and Canada. Exactly what they're going to be, I'm going to leave that for the president to decide. This president is totally focused on building America back, and we're going to use tariffs to create fairness. We need fairness, and we need the strength of Donald Trump to make the world reasonable to America and stop picking us off. It's over. Donald Trump's going to end it and make the world trade fairly with America, finally.
The Trump administration preparing to implement 25% tariffs on Canada and Mexico and an additional 10% levy on Chinese imports tomorrow. Bloomberg's Tyler Kendall joins us from the White House with more. Tyler, I'm going to ask you, do we have a clue what's coming in the next 24 hours?
Well, John, we have to keep in mind that this specific batch of tariff threats are tied directly to some tangible policy priorities for this White House when it comes to immigration and fentanyl. A White House official confirms to Bloomberg News that President Trump is tracking overdose deaths as a metric of progress when it comes to this. Although when asked last week in the Oval Office if he was satisfied with the numbers he's been seeing, he said, quote, not at all. Now, Canada and Mexico have both surged resources, tangible resources, to the border. But something that we are watching closely is whether or not either of those countries implement their own tariffs against China, something that Treasury Secretary Scott Bessent told Bloomberg Television in an interview on Friday this White House is keen to see. We should note that our reporting indicates that Mexico is indeed open to that and that Canada has enacted similar measures, most recently in October, putting a 100% levy, for example, on Chinese-made electric vehicles.
Tyler, appreciate the update. More from Tyler Kendall throughout today on Bloomberg TV. Michael Zezas of Morgan Stanley joins us now here in New York City. Michael, good morning to you.
Hey, good morning.
The words of the Commerce Secretary. There are going to be tariffs on Tuesday on Mexico and Canada. Exactly what they are, we're going to leave that for the president and his team to negotiate.
Yeah.
I'm going to ask you a dangerous question. What's your base case?
The base case is that we think these tariffs will be pushed off. I think there's more common ground with Mexico and Canada than for China, for example. So we do expect the China tranche will go on. But if I pull back for a second, I think our base case, when we're talking to clients, differs a little bit from others. But where there's common ground is that everyone expects tariffs will go higher. By the way, I think that consensus is right. So in the fullness of time, we're still dealing with the U.S. that's going to raise more tariff barriers. And whether or not you agree with the goal, the ultimate goal of what that's going to achieve, and whether or not that's beneficial over the long term in terms of reindustrializing the U.S., for example, it comes at a cost. So we're really kind of focused on the growth pressure that creates over the next year or two. I think there's some important read-throughs for investors there.
Michael, how much is this about China in the end anyway? Scott Bessent on Friday told Bloomberg TV, the Treasury Secretary, that how amazing would it be if Mexico and Canada both imposed their own tariffs on China to have one fortress North America?
Yeah, I mean, I think there is a common goal here around China. It's hard to know that it's specifically all about China as opposed to there not being specific goals with Mexico and Canada. But I think it's clear from both Trump's first term and everything that's been said by his advisor since that term that there are far greater conflicts of interest between the U.S. and China in how that trade relationship progresses, both in terms of the magnitude of the trade deficit, but also how the U.S. wants China to operate in terms of a free trade arrangement that we really don't think China's going to be willing to make a lot of those concessions. In a lot of ways, it's anathema to how they manage their political economy.
So say your base case is accurate. The 25% on Canada and Mexico and 10% on Canadian oil does not go through, but an additional 10% goes on Chinese imports. What's the retaliation going to be from Beijing?
Yeah, I mean, I don't know exactly what that'll be, right? I mean, China, at least if we follow the prior pattern from the last retaliation, they kind of go less, and maybe they're hoping that if they can engage in a broad negotiation with the U.S., that maybe they can get to some arrangement that's going to be less complicated or less impactful than what Trump and his allies have been threatening, trying to get to something like 60% tariffs on all imports. At the end of the day, we think where we're headed is to a much higher level on China tariffs because we don't think there's a lot of room for success inside of those negotiations. Again, I think some of the things the U.S. is asking for from China, which they asked for in the first Trump administration, were really just anathema to how China wants to manage its economy. So the U.S. probably has to raise tariffs along the way in an attempt to negotiate, but they ultimately stay higher. I think that differs in a way from what they are likely to get out of Mexico and Canada in the fullness of time, which is a lot more cooperation.
I want to pick up on something you said, which is implicitly increased costs as there is a more rapid deglobalization. How are companies preparing for that? Where are they moving production? How much are they trying to actually bring production back to the U.S.?
So it's really complicated because after Trump's first term, you did see a pickup in foreign direct investment into the U.S. You saw companies trying to reshore, nearshore, and you saw investment in Mexico as a consequence. But we did a piece of research with our colleagues in economics, and we really kind of looked at what supply chain realignment had happened already. And what you saw was that the low-hanging fruit had kind of already been picked, right? So what's left over now for supply chain realignment is complex products in concentrated areas that are geopolitically very different than the U.S., right? Like bringing complex supply chains out of China. So that's a very costly endeavor. So even if you raise these tariffs and create the incentives for that reinvestment, it's costly. It's going to be fed through to companies and to the consumer in some way. So again, this transition might be a good thing for the U.S. in the fullness of time, but it costs something along the way, and that's kind of part and parcel of the growth pressures that we expect to see over the next year or two.
What really interests me at this moment is the way that administration officials talk about the U.S. economy as if it's still Joe Biden's, the former president. And the way Secretary Besson talked about it is that it won't be President Trump's for another 10 months or so. It's almost conceding that the weak data we might be getting over the next several months or so is someone else's fault.
So is there a date at which it's no longer the Biden economy? I'm serious. I mean, this was actually something I was thinking about over the weekend. You know, how long? What's the expiration date of blaming Biden and going back to that every single time?
From the NEC director, Kevin Hassett, when he joined us after payrolls, said something similar. The economy we're inheriting is not as good as people think it might be.
So are they going to embrace the weak economic data and say, look at how terrible it is? We can come in and salvage it with...
We'll see. Michael Zezas of Morgan Stanley. Michael, thank you.
Thank you.
Equity futures right now, session highs up by 0.6% on the equity market. Chris Harvey of Wells Fargo joins us next. Equity futures positive here, starting the week in the right way, up by 0.5% on the S&P 500. On the Nasdaq 100, up by 0.75%. The Russell bouncing back from some steep February losses. We're up by 0.9%. Check out Europe. Look at this rally. The equity benchmark in Frankfurt, Germany, the DAX, record high, up 2.4%. Over in Paris, record high. The CAC 40 up by 1.4%. Year to date, in Paris, France, we're higher by about 12%. On the DAX, we're up by 16 percentage points. It's March 3rd. What a rally we've had. 2 hours away from the cash open stateside. Manus Cranny, some of the moves we're seeing in the defense sector, just phenomenal.
Jonathan, let's kick it off with Rheinmetall. This is one of the big German defense players. This is about a wholesale re-rating of what Europe will spend on defense. And boom went the European producers. JP Morgan raised their price targets across the sector, anywhere up to 25% up on the price. It's about turbocharging European rearmament, and it is manifest there, up 12%. Roll it over, have a look at Capri. We've got reporting that Prada are close to a deal to buy Versace, 1.5 billion euros. Capri bought that business back in 2018 for 1.8 billion euros. And just take your mind back to the autumn, the FTC blocked Tapestry for bidding for Capri, and it was down 45% on the day. So we're better bid there. MicroStrategy, 3 beautiful words from the president, crypto strategic reserve, and boom goes Bitcoin and the rest of the complex as well. We're up 13% this morning as President Trump on Truth Social talks about this crypto reserve for the United States of America. And it's a family of reserve: Ethereum, Ripple, Solana, and Cardano. Jonathan.
Manus Cranny, thank you, sir. Appreciate it. Hard to keep up this morning with some of these moves. Let's start in Europe. Equities racing away in the bond market. In Germany, the 10-year bund yields are higher by 9 basis points. Lisa, further out along the curve on a 30-year, up by 10.
This is beginning to price in what a 900 billion euro defense and infrastructure fund might look like in terms of financing. I just wonder how far we're moving into conviction that this has any chance of going through, given the fact that there still is, really this incremental feel to some of the shifts that are going on. I mean, the EU, the idea about cars not having to comply with CO2 mandates highlights just how many small things have to go before you start getting even bigger discussions, really, in a serious way.
And I've said this once already this morning about something else, but the chances aren't zero and the chances went up. It's kind of the European story right now, right?
Well, so this is actually raising a question of the bar isn't just really low anymore, but it's not exactly high. Mohamed El-Erian saying it doesn't exactly make him optimistic about Europe. Maybe it just means that there are more questions elsewhere.
Big move in the equity market higher, in the bond market softer. Yields up. On our radar this morning, President Donald Trump's first tariff deadline looming tomorrow. The U.S. preparing to slap 25% tariffs on imports from Canada and Mexico and double a levy on China to 20%.
So there's a big question, really, not so much on China when it comes to the additional 10%, bring it to 20%, but on Canada and Mexico, because Howard Lutnick called the situation fluid, which means they've been in negotiations. We've seen a flurry of diplomacy with Mexican officials and Canadian officials coming to Washington, D.C. I was in D.C. last week. They were all there trying to come to an agreement. But then Mr. Lutnick said in that same interview, tariffs will go on Tuesday. I'm just not sure the level.
So what is the level? Clearly, why did he say that? If 25%, and also he said something else that was interesting to me, and you mentioned it too. He said we need to negotiate with the teams. He's part of the team, and then didn't give us any colour whatsoever. He made it sound like it was someone else's call, plus the teams that negotiated with it, even though it's his team.
It feels a little bit like cats in a bag, and there are lots of different views, and clearly that's the case.
It's as if the President of the United States has actually not decided yet.
I get the feeling that he hasn't. And tomorrow's a big day. It could be 25% on Mexico and Canada. And the very fact that we're just accepting that it's going to be another 10% on China, and that's OK because there's a bigger thing out here, it's kind of where we're at.
There's also a feeling that we don't know, and we don't know what we don't know. And honestly, at this point, companies just aren't doing anything. And again, how long does that uncertainty be prolonged, and at what point does that have an economic toll?
More on the trade stories. We approach that trade deadline through the next 24 hours right here on Bloomberg. Need to get you the latest on foreign policy. Israel halting humanitarian aid to Gaza after a 6 weeks truce with Hamas expired. The move coming after Hamas rejected a new U.S. proposal calling for extending the ceasefire through Ramadan and the Jewish Passover holiday.
So Steve Witkoff, the president's envoy, wanted to extend the first phase of that ceasefire. And Hamas says, no, we should be moving into phase 2, which means Israel needs to leave. And Israel's like, we still have hostages there. Not enough has been done. So now they're halting humanitarian aid. This is becoming very problematic for Qatar, for Jordan, for Egypt, which are saying that aid needs to go through because we're the ones that are dealing with the influx of Palestinians. This is another massive issue that this White House needs to be dealing with at the same time that they're dealing with what happened on Friday and the blow up in the Oval Office, dealing with Europe and Ukraine. Just another laundry list of conflicts and issues around the world.
Just getting an update from the Oval Office, from the White House. Trump to make an investment announcement today. It's on the schedule for 1:30 Eastern time. We'll get some more details when we have it. I imagine it might have something to do with the tweet over the weekend about crypto, possibly, potentially.
The issue with the crypto, a lot of even conservatives are saying, what is this about? Why is taxpayer money going to be funding this? Can this potentially devalue or lessen the importance of the U.S. dollar when you're talking about a strategic crypto reserve? Lots of questions we did not get. All it did, though, is fuel a lot of speculation in this market.
Certainly an opportunity for the press to ask some questions about that trade deadline. That's taking place at 1:30 Eastern time. Wanted to squeeze this in. Singapore investigating whether Dell and Supermicro servers shipped to Malaysia contained NVIDIA chips barred from China. The case highlighting the role of middlemen in funneling high-end semiconductors. They're not letting this go, and they shouldn't let this go. How are they getting into China?
Well, and it raises this question of how Singapore, as well as Malaysia and Vietnam and Thailand, try to get on Donald Trump's good side so that he doesn't force them to make a choice about whether they're with China or whether they're with the U.S., because they have benefited from this sort of fissure. They're going to act hard on this so that they can avoid the wrath and the consequence of this White House.
Just how export compliant was DeepSeek? Keep going back to that, don't we?
Front page of the Wall Street Journal this morning. NVIDIA AI chips reach China despite the U.S. ban. Traders in the country are selling computing systems with NVIDIA's Blackwell chips installed by routing them through third parties in nearby regions. So the export controls I think you're going to see out of this administration is going to be focusing on allies and foes of the United States if they're not compliant with those export controls. And there's a way that on the black market they're getting into Beijing.
That's the latest on chips. Let's turn back to the equity market. Equity futures rallying stateside. Over in Europe, a rip-roaring rally. Chris Harvey of Wells Fargo writing, in a lower oil, inflation and rate environment, we would expect a very different investment set from the last 12 months, namely rest of the world over the United States, value over growth and cyclicality over momentum. Chris joins us now for more. Chris, good morning.
Good morning.
Let's start with the US versus the rest of the world. What a rally in Europe.
A heck of a rally. So I was there in October and sentiment could not have been worse. And everyone's saying it's so bad, should we be contrarians? And everyone wanted to wait for the election. And I think they waited for the election and then bang, there we have it. But I think the real catalyst is you're finally starting to get some optimism around Russia and Ukraine. And you get optimism around Russia and Ukraine, you can see an environment where oil comes down, inflation comes down, and rates come down. And that's really positive for Europe.
Just quickly then, it's not stimulus dependent. This is something else potentially.
No, it's not stimulus dependent. So what we look at is the administration really does want lower oil, because what does lower oil do for them? Lower oil does, I think, put weight on inflation, it puts weight on interest rates, and that is something that they really, really want. So it makes Ukraine, a resolution in Ukraine, a big priority. But the funny thing is, the Europeans probably benefit more than we do.
Is the bar still low for some sort of positive development in Europe, or is the bar now appropriately set?
I don't know if it's appropriately set. I think people are still skeptical. The fundamentals are pretty attractive. Or if you look at it, what do we have? We have a situation where you have good valuation. The economy is not so great, but can improve. The ECB is still cutting or still in a rate easing cycle. And then you have catalysts on the political and possibly on the energy side. And by the way, the currency has been devalued. So that's a pretty good combination. Yes, it's pop, but that place has been a malaise for a long, long time.
How much is this just that people don't want to think about the U.S. and try to unravel and untangle the complicated story that is momentum unwind, maybe, that might be a growth scare, but not really, but might be something with respect to uncertainty, but maybe just something that's a hangover from the past? I mean, find your narrative. It's very confusing.
You can pick it, because when you're talking about that, I was like, should we talk about momentum? Should we talk about Europe?
But that's my point. It's a flood the zone kind of thing in the White House. When you hear people talk about the stock market, honestly, it's tortured because people feel like they have no conviction about anything, and it's hard to get sort of an angle. So is that the reason why people are going outside the U.S., because they just don't want to think about it?
I think to a degree it is, but again, you do have those catalysts. And more importantly, let's just kind of talk on something that it's very hard, as you're pointing out, it's very hard to handicap the macro, right? We can talk about tariffs as much as we want, but we don't know what's going to happen. What we tell people is the only way to hedge that uncertainty is you need a certain allocation to low volatility in order to hedge that uncertainty. And so one of the things we've been counseling our clients with is in your portfolio, you need an allocation to low volatility. And low volatility is one of your better performing sectors and groups year to date. And I think it will continue to perform and it will continue to help out that portfolio because you need to be able to stay in the game until we get resolution on a lot of these things. And it could happen in 3 weeks, could happen in 3 months, could happen in 3 years. We're not sure.
Let's talk about the tariffs tomorrow because you think this administration wants lower oil prices. But if that's true, then why slap 10% tariffs on Canadian oil when last year we imported more than 60% of oil from Canada?
Annmarie, that's a $64,000 question. It's a great question. Are they using tariffs? What exactly are they using tariffs for? And what exactly do they want? We think they're using tariffs more as a cudgel to get certain things, whether you're going to pay a tribute, whether you're going to get some concessions. Really, tariffs are not about generating revenue. Right. And I think what it's also about is it's setting that kind of psychological bar. We're going to do what we say, and that's going to put people on their back foot. Maybe that causes some people into unforced errors. And that's really what I think it's all about. It's not so much about revenue generation.
So if we're continuously in that cycle, how much can that affect the stock market, just in itself, even if the tariffs don't come to play?
So here's a thing that's popped up over the last couple of days, last couple of weeks. What I've heard is, hey, sentiment is turning very, very poor. It's fading. What I'm also hearing is more and more talk about stagflation. I don't know, and I've talked to a lot of people about, well, does the sentiment really affect activity? We don't know. right? If this continues, the answer is eventually, yes, it does, but right here, right now, unclear at this point in time. So that's why we continue to point out you have to have some risk aversion in the portfolio. You have to have some exposure to low volatility, because that's the only way I know to handicap the uncertainty.
Is exposure to low volatility code for holding a lot of cash?
No, not necessarily. It's code for looking at stocks at the lower end of the risk spectrum. They don't have to be utilities. Like, for example, in financials, typically what you see are insurance companies are a little bit lower volatility, because those lower volatility stocks, what they do in sell-offs, they typically outperform. They anchor that portfolio. But they are also capable of participating to the upside. So it's a really unique dynamic. It's a really unique play. And it's one of the few ways that I think is going to help you navigate these difficult markets.
Chris, how are utilities behaving at the moment? You brought up that sector. What do you do with them now? How do they fit into a portfolio, given it was a big AI trade over the previous 12 months?
So, John, last year we came into the year overweight utilities. We downgraded utilities from overweight to neutral back in September. That's where we sit right now. We like the space, but what we're telling clients, if you want, on a sector basis, if you want something more defensive, it's, it's staples. Because, as you point out, the utility trade has got caught up with the AI trade, and it may not give you that defensive properties that you want.
It's not the bond proxy it used to be.
Exactly. And you have very, very different dynamics with some of the Genco companies and the distributors. We wanted something that when stress comes in the marketplace, it's going to work, and that's what you've seen with staples.
Is it funny there's so much stress around at the moment regarding this market, and yet we're not down by even 5% on the S&P?
Yeah, and what we tell people is, take a look at low volatility, take a look at value, take a look at Europe. Those are pretty strong markets. What's weak is growth is weak at this point in time. And getting back to Lisa's comment about momentum, people think, oh, tech is momentum. Well, if you look at the MTUM or the momentum ETF, tech is the most underweight sector of any sector represented in the momentum index. What's momentum now is financials and communications.
Chris, appreciate your insight as always. One of the best. Chris Harvey there of Wells Fargo on the equity market. Let's get you a quick update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Crypto recouped some of last week's losses over the weekend after President Donald Trump posted on Truth Social yesterday about his plan for a strategic reserve that includes more tokens. Many of the details of the president's plan are unknown, including how much the government will actually buy and how the purchases would be funded. Kroger chairman and CEO Rodney McMullen has resigned from the company. The news follows a broad investigation into his personal conduct. The company issued a statement confirming the conduct in question did not relate to operations or financial performance and did not involve Kroger associates. The board appointed lead director Ron Sargent to serve as interim CEO. And in sport, Fulham are headed to the FA Cup quarterfinals after beating defending champs Manchester United on penalty kicks. Fulham took a 1-0 lead into the half before Bruno Fernandes tied things up in the 71st minute at Old Trafford. Fulham's keeper saved 2 penalties to win the shootout 4-3. They'll be facing Crystal Palace in the next round. And that's your brief. John.
Danny, thank you. I tortured myself watching that game yesterday. I have no idea why.
I was about to say.
Absolutely dreadful.
I thought you were off that. I
Just
thought you were trying to kick the
such
habit.
low-quality football. They look like a team that's about to get relegated.
I thought you didn't want to deal with the emotional turmoil.
Well, I didn't have any emotion in this game. I don't support either side.
Yeah, but you still are just angered by the absolute dreadful playing of football.
Just awful football from Man United. Clearly someone in the control room does not like Man United, and that's why that story got in there. Up next on the programme, preparing for tariffs.
I do think one very interesting proposal that the Mexican government has made is perhaps matching the U.S. On our China tariffs. I think it would be a nice gesture if the Canadians did it also.
That was the Treasury Secretary Scott Bessent negotiating in public. Mark McCormick of TD joins us next from New York. This is Bloomberg. Big rally over in Europe, all-time highs over in Paris, France. Stateside equity futures a bump higher, up by 0.5% on the S&P 500. There's the move in foreign exchange. The dollar weaker, euro stronger. Euro dollar up by 1%, approaching 105 at 104.74. under surveillance this morning, preparing for tariffs.
I do think one very interesting proposal that the Mexican government has made is perhaps matching the U.S. On our China tariffs. I think it would be a nice gesture if the Canadians did it also. So in a way, we could have Fortress North America from the flood of Chinese imports that's coming out of the most unbalanced economy in the history of modern times.
So here's the latest this morning. Global currencies under pressure as the Trump administration prepares to impose new tariffs on Canada, Mexico and China. Mark McCormick of TD writing, our positioning and short-term valuation tools tell us the dollar is oversold and cheap, a setup we haven't seen since before the election. Mark joins us now for more. Mark, welcome, buddy. It's good to see you. Let's pick up on that line. The dollar's oversold and cheap. Against what?
Against everything. I'd say the thing that's probably standing out the most is EM currencies. It probably goes back to your last segment when people are talking about low volatility. You know, the FX market's version of low volatility is a carry trade. So EM currencies have come back, but as well, G10 currencies, particularly you're talking about the euro here, all these things look overbought. I think one of the things that's very interesting is we get kind of fixated again on a theme or a news story, or we're talking about geopolitical tensions, or we're talking about tariffs. We forgot about market fundamentals a little bit. And if we go back to, you know, kind of the positioning and some of the valuation drivers, what's happening behind the scenes is the market is extremely short the dollar now. Like, we have given up on the premium that's come through the dollar. We're forgetting that inflation, growth, relative fundamentals, at least where we're at right now, are still much better for the U.S.
So, Mark, does this mean that you're leaning into the dollar and you think that the dollar could reclaim all of the gains that it's lost since the inauguration?
I think there's a couple ways to think about it. There's kind of the short-term tactical setup, which we are very bullish the dollar on that. And then there's a longer-term forecasting period, which is next 6 months and next year, where we are actually bearish the dollar. Because we are in different regimes, we are in different environments, and the markets respond to different drivers through those timelines. So I think the piece of it here is that what you have to do is you have to connect the narrative to what everyone's talking about, to what's actually priced in and where markets are positioned. So again, we came into the start of the year when we had these conversations last year. Our view was that Goldilocks was an environment that wasn't going to play out. There wasn't enough volatility price in the markets. U.S. fundamentals were good, and the dollar was basically oversold. We have now swung to the other side of the pendulum here, where, again, the dollar was overbought for a little while. We came into the start of the year. Tariffs didn't deliver. There wasn't as much shock value, so the markets were disappointed. Now, again, we kind of swing back. So the dollar looks cheap. The markets don't seem to think about tariffs at all. It's very complacent. We have moved back into low volatility strategies. And another thing that's happening in FX is value is working. So all the lines you hear people use in the equity market is also working in the FX market, because the FX market is driven predominantly by equity trends. So I think a big piece of what's going on here is inflation, growth, the macro story, and now the technical setup still favor tactical dollar exposure, which is, again, the BDXY, the Bloomberg Dollar Index, to 1325, which is euro still around 102. Essentially, if we look at dollar China, we're still around 730. Weaker currencies across the board, driven primarily, again, through emerging markets, again, through higher stress.
I want to pick up on the euro, Mark, because you can overlay to all of these questions about the economy, fiscal questions as well, particularly when it comes to Europe trying to beef up some of its defense spending. Is your 102 valuation on euro dollar essentially a rejection that the European Union is going to come together with any kind of fiscal bazooka like what we heard being proposed by Reuters, by economists in Reuters over the weekend?
No, I think that's, again, it's a longer term story that people are kind of condensing into the immediate price action. So if you unpack all of that, you know, what is the thing that matters most to the euro in Europe in this context? It's energy prices. And so while we're kind of looking at whether or not this is a positive terms of trade shock, which reverses from what we saw in 2022, there's a lot of things that need to come into place. Like, energy prices actually need to come down to a level where, again, how is Europe going to how is it going to build production around this? The pipelines haven't been used for years. So there's a lot of degradation that's happened in the pipelines. They're not efficient at the moment. You can't just turn these things back on and then everything becomes cheaper again. So even you could see it in the futures market. You could see it in the energy markets. So this isn't something that's just going to happen overnight. So what the markets are building into are the expectations around an improvement in the European growth situation. But again, even if we get a $200 billion defense spending package, it's going to come through the rates market. But again, the immediate risk here is that tariffs come back. So basically what you can see is steeper curves in Europe. You can see the term premium, you can see a fiscal premium driving the back end of European curves, but you could also see the front end coming down because the ECB, the Bank of England, the European central banks are all dealing with negative growth shocks, which is what is more immediate than everything that's being priced in for the next 12 months, the next 24 months, which again reinforces our call that we will see a peak in the dollar. It's going to probably come this quarter, but tactically you should be buying the dollar to trade it to generate alpha, and you should be thinking about hedging risks of a weaker dollar over a next year or 2 years. And I think that's where the markets are completely dislocated on drivers that can be short-term versus drivers that are more longer-term.
Mark, I'd love to get your sense of what do you think this crypto reserve could actually mean for the U.S. dollar? Could it hurt it?
It could. It's an alternative source of currency. Again, I think a part of it here is that there's probably a little bit more rhetoric and a little bit more entertainment value than, any kind of real policy that comes in place from a crypto reserve. But again, anything that kind of reinforces alternative currencies to the dollar that the U.S. is basically building up assets around would mean a weaker dollar. So if this was done in principle and this was done in practice, again, this would be something that would weigh on the dollar because you're basically funding an alternative reserve currency that whether or not it would be the euro, the Chinese renminbi, or crypto, this is something that would be negative. But again, I think this is something it's in terms of the importance of what's driving FX, this is way down the tier spectrum. I'd say a tier 3, tier 4 driver that we don't even have clients that really even have asking questions about at the moment.
Mark McCormick of TD Security. Mark, thank you, sir. Euro dollar with a big move today, positive by 0.9%. A lot of that coming from the euro side. We're approaching 105 as the push for defence spending ramps up on the continent. Up next on the programme, we'll catch up with Liz Young-Thomas of SoFi, Joe Feldman of Telsey Advisory Group, Steve Ricchiuto of Mizuho, and Robert Tipp of PGIM Fixed Income. From New York, the third hour of Bloomberg Surveillance. Up next.
All of these high momentum stocks have started to pull back pretty significantly, and we think it's just an unwind of that crowded positioning.
I don't know that it would necessarily be a bad thing to see that broadening out in terms of performance.
Some taking of gains is to be expected after such a strong fourth quarter, all to be expected and could also be attributable to seasonals.
A key pillar of this bull market has been the resilience of corporate earnings.
If you can't see earnings broaden out, then it's a huge problem in the market today.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now with a big rally over in Europe and some positive follow-through stateside. Equity futures on the S&P 500 higher by 0.5%. On the Nasdaq 100 up by 0.7. On the Russell up by 0.9. Your week ahead concludes with payrolls on Friday and an address from the Federal Reserve. Chairman Jay Powell. Look out for that at the end of the week. At the beginning of the week, we're all staring down a barrel of 25% tariffs on imports from Mexico and Canada and an additional 10% on China.
This will be a clarifying moment. If they go on, you'll have to see a pretty big repricing in a couple of stocks, if not a broader market move. As we were speaking with Lori Calvasina of RBC Capital earlier this morning, and what she said, I just wonder how this feeds into what some people are talking about, which is essentially paralysis in the C-suite. How do you come up with bigger plans if you don't understand the ultimate goal or the ultimate number when it comes to tariffs? And that, I think, is going to be an ongoing theme.
It's hard to read the tea leaves around Canada and Mexico because Howard Lutnick said it's a fluid situation. There's been a flurry of diplomacy in Washington, D.C. between Canadian officials and Mexican officials trying to offer up enough concessions when it comes to what the U.S. and Donald Trump want to see. But then he said in this interview, there's going to be tariffs on Tuesday on Mexico and Canada. Exactly what they are, we're going to leave that for the president and his team to negotiate. But that sets the bar that tariffs will go in place, that there won't be another pause. And that's why it's a little bit confusing.
We know what the president wants to see in Europe, that's for sure. More defense spending. Check out European markets today. German bonds lower, bond yields higher, defense names rallying really hard. Rheinmetall up by 13%, BAE Systems up by 14, all-time highs in Paris, France. On the equity market, the euro stronger. Where'd you begin, where'd you end?
Well, this begins with the idea that maybe there could be a real bazooka when it comes to fiscal and defense spending in Europe, unlike what Germany certainly has seen since the reunification with East Germany. Question of how feasible this is, question of how low the bar actually is, and question of just whether there is the collective will, let alone the financial power, to borrow at that kind of level.
Deutsche Bank saying this morning potentially a fiscal regime shift of historic proportion. We've said repeatedly on this program, the President of the United States is forcing the Europeans to do some things that might actually be good for the Europeans.
And Friedrich Merz is saying the exact same thing. The U.S. is putting enormous pressure on Europe to act, which is why you have this report from Reuters about how much money they're looking at for a defense fund. Merz is saying they haven't discussed a date yet and for the convening parliament, but they will be discussing with their partners at what this means. And guess what? There's another European summit on Thursday. They love a summit. And potentially we're going to get details of how much they're willing to spend on defense just this week.
I mentioned this quote from the Polish Prime Minister over the weekend. Europe awakened, Europe understanding its global potential will be America's most desirable ally. That's exactly what the president wants to hear.
And this is the reason why, and frankly, let's just be honest, this goes back to Nixon. I mean, this has been something that U.S. presidents have been asking for a long time, contribute more to defense spending. Whether Europe does it or not, obviously, there are a lot of summits to be had. I do wonder, though, how much this is the goal and whether this is a cohesive goal to ultimately beef up Europe at a time where the U.S. wants to rejigger supply chains in a more dramatic way.
What did you say the other day? Because that's really the mentality of this administration. Europeans have nice trains and functioning infrastructure because an $800 billion U.S. defense budget.
Don't upset President Biden. Trains are great here stateside, aren't they? You love them.
Well, I'm sorry. I was in Austria and they lost a train. So they lost a train car.
Almost as good as the airplanes in America.
Pretty good. Equity futures on the S&P. Not going there. Equity futures on the S&P 500 up by 0.4%. Coming up on the programme, Liz Young-Thomas of SoFi on the momentum reversal, Joe Feldman of Telsey Advisory Group looking ahead to target earnings, and Steve Ricchiuto on why he's constructive on the US economy. We begin this hour with stocks looking to rebound following last month's losses. Liz Young-Thomas of SoFi writing, there's been a notable shift in which stocks, sectors and assets are leading or lagging the broad market, and it's one that can be best described as a reversal of momentum. Liz joins us now for more. Liz, I just wonder in your mind whether it's anything just more than that. We've had discussions about a growth scare, and based on the conversations we've had on this programme, it feels like there's been a massive sentiment shift. And then you look at the equity market and it's down by not even 5%. How do we square that circle?
Well, I think there has been a sentiment shift in the sense that everything that got us here for the last 2 years has now gone a little bit out of favor. And you could have seen some of those markers in the second half of 2024 in terms that you look at just the AI-related stocks, the big tech stocks. There'd been more scrutiny over the spend and the expectations. So now coming into 2025, investors started to look for growth in other places and then layer on top of that the fears about economic growth. So when we're looking at this rotation that's occurred under the surface in sectors, I think it's quite healthy. The difference is that you need a number of different sectors to keep up and to pick up the slack if technology stocks are not going to be the darlings again in 2025.
So, Liz, let's pick up on the growth scare theme. Discretionary's had a difficult run of it, but you could say a lot of that is just Tesla. We have seen the bond market start to respond, though. 7 consecutive weeks of lower bond yields on a 10-year maturity. Are you seeing high-yield credit confirm some of those growth jitters?
You do see high yield responding to that considerably. And that's been something that if you look at just high yield spreads over the last few months, you've seen this grind lower in spreads. High yield, as we know, is highly correlated with the equity market. But there has been a spike in high yield spreads over the last, let's call it 3 to 4 weeks, which I think, again, is healthy. There should be a correlation with the equity market. The big change that's occurred so far in 2025 is that yields started to respond, and I'm talking about 10-year Treasury yields, started to respond to growth fears more so than inflation fears. So what we were seeing in the latter half of 24 and even the early weeks of 25 were that the 10-year yield was rising because of inflation fears. Well, now the 10-year yield has come down quite a bit because of growth fears. The shift, though, is that that drop in the 10-year yield has not served as a tailwind for stocks. So you're seeing those growth fears bake through into stocks, into high yield spreads, and into the 10-year Treasury yield.
The reason why it is such a difficult market right now is because there's so many different themes that are layered on top of each other. We started the show talking about the potential for tariffs to come on Tuesday, a potential response from the European Union to different geopolitical developments, including the meeting on Friday with Volodymyr Zelensky and Donald Trump. Liz, from your perspective, what is more interesting to you this week and has the bigger catalyst effect potentially on the markets? What we get on Tuesday with respect to potential tariffs and the State of the Union, or the economic data that culminates with the non-farm payrolls report on Friday?
Well, of course, if the non-farm payrolls report is a surprise of some sort, that'll be likely the more market-moving event. The tariffs, if they do go into place as announced tomorrow, the market really already reacted to that back in January. Now, of course, there needs to be some repricing. There's been quite a bit of volatility since then and a lot of uncertainty. But if we do get a surprise on the payrolls report, I think that's a more market-moving event. The trouble is that we have to make it all the way through the week before we get there. So I don't expect a huge surprise on that payrolls report yet. I do think that as the first half of this year progresses, we're going to get some bumpier data in payrolls, largely because of some things that are going on in Washington and just weather patterns, other things that could be going on in the construction market, and the fact that mortgage rates have stayed so high, so the construction market has slowed down a bit. But I don't expect a huge surprise this week in payrolls.
Okay, so given all of this, are you actually leaning into some of the sell-off, or do you think that actually that this is a sign that things are going to be jittery for a while and people probably should reduce risk on some level because of that uncertainty?
I think you have to, first of all, define what you mean by reduce risk as an investor. So if you're looking at your portfolio and you are overweight, naturally, some of those Mag 7 stocks, technology, certain themes, maybe it's the AI theme, many investors have become overweight those themes just because the performance has been so strong for the last 2 years. So if you're looking at reducing risk by diversifying out the drivers that you're exposed to in the portfolio, yes, absolutely, I do think it's time to do that. And I think you can broaden out into some sectors that have the opportunity to produce growth, but are trading at lower multiples and aren't quite as exposed to some of this volatility that's occurring on a day-to-day or week-to-week basis. Those sectors, for me, would be healthcare first and foremost. I'd be looking at things like materials if we're worried about inflation heating up again. You can look at industrials. You can look at financials. Financials haven't traded great for the last few weeks, but that could be an opportunity. And then I still really like gold here. Despite the fact that it's hit new all-time high after new all-time high, there continues to be a lot of appetite in that market, both institutional and retail.
Massive run over the last year. Liz, appreciate your time, as always, and enjoyed the recent note as well. Liz Young-Thomas there of SoFi. In Liz's note, basically 2025 so far is 2024 upside down. Essentially, losers versus winners in 25, flip it the other way for 2024.
And really, she pinpointed the major change that has happened, which is that the decline in yields, the rally in treasuries, has not been the tailwind for equities that a lot of people believed that it would be, and it has come perhaps an increasing number of growth fears.
Equities doing better this morning. No signs of growth fears over in Europe. Massive spending plans apparently coming together. Bonds down and yields up and equities rallying really hard. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Trump is expected to make an investment announcement, at 1:30 p.m. Eastern this afternoon. It comes ahead of tomorrow's tariff deadline on Canada and Mexico and a joint address to Congress later on in the evening. Let's get a check on shares of Intel. They are gaining 5.8% to the pre-market on the prospect of a manufacturing partnership with NVIDIA and Broadcom. Reuters reporting that the chip giants are running tests on Intel's so-called 18A advanced chip-making process. So far, the company's declined to comment. If an agreement is reached, it could generate hundreds of millions of dollars in contracts for Intel. Andrew Cuomo has announced that he is running for mayor of New York City. The former three-term governor of New York resigned in 2021 amid multiple allegations of sexual harassment. He enters a crowded race with challengers vying to unseat the incumbent Mayor Eric Adams. Cuomo's decision to run has upended the race, with several polls showing him leading the field. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, the Morning Calls Plus, Joe Feldman of Telsey Advisory Group looking ahead to earnings from Target and the prospect of tariffs on Mexico, on Canada, on China. From New York, this is Bloomberg. Equity futures on the S&P positive here by 0.4%. Stateside, a nice bounce. Over in Europe, a really big rally. We'll talk more about a little bit later. Let's get you some morning calls. First up, JP Morgan downgrading Southwest Airlines to underway, citing its surging valuation premium. That stock is down by 2%. Your second call from Morgan Stanley naming Tesla a top pick, highlighting opportunities in autonomy and robotics. That stock is up by 3% in early trading. And finally, Evercore adding Target to its tactical outperform list, saying it sees opportunity for the stock to, quote, play some catch-up. That stock is up by a little more than 0.8%. Let's stick with Target. Joe Feldman of Telsey Advisory Group keeping an outperform rating on the stock with a 150 price target, writing Target continues to elevate the customer experience and enhance its product offering through partnerships and popular brands. Joe joins us now for more. Joe, welcome to the program, sir. Can we start with tariffs first? I think we've got to. If we do get those tariffs on Mexico, on Canada, additional tariffs on China, who in retail, including Target, is most exposed?
Yeah, you're going to have a lot of exposure to just broadly to retail, and it's going to be a challenge for everybody. It's going to take prices up. That seems to be very clear. The retailers have told us they're going to negotiate with the suppliers and try to share some of the burden, but some of the burden is going to be shared by the consumer as well. It's interesting because the first go around with tariffs with China, the grocers or anybody with a heavy grocery contingent of their sales, like a Walmart or obviously Kroger, Albertsons, the true grocers, Target, even Costco, they really avoided a large part of this. But now with Mexico and Canada, that could be a big hit on the grocery side because of the produce that comes from is particularly from Mexico. And so there's going to be a lot of issues. I think that there's a lot of retailers. I mean, first go around, a lot of lumber comes from Canada. The home improvement guys sell a lot of lumber and building materials. There could be issues there. The home builders obviously would have some pressure as they're trying to build more homes. So I think there's going to be some issues for the consumer go forward if these tariffs go into effect.
Joe, from a retailer point of view, is it better to be bigger when facing off with some of these potential tariffs, given that you have a greater degree of power over your supply chain?
Yeah, I think that's a great statement. It's much better to be bigger. I mean, Walmart, when they hosted their earnings call 2 weeks ago or a week ago, they did not seem too worried about the tariff issue. They dealt with it before. They know how to deal with it again. They've diversified their supply chain the last time this happened. And as you said, they can use their buying power and their scale. And so, it sort of starts at Walmart. You can go down the list and really get a sense of where there's the ability to do that. Obviously, the big box guys, some of the ones that I cover, have a little more ability to spread it around. But there's still going to be some impact. We saw it last time, and we're likely to see it again this time.
I wonder if there's almost a perverse benefit to some of the largest retailers if some of the smaller retailers go out of business or can't handle a potential added cost, which we've already seen on the margins. Does that seem possible to you?
Yeah, I think in this environment, anything's possible. I think that, there's a hope that the regulatory environment will ease enough and that will help on the tax side of things with the burden. But there's still going to be some issues. I mean, it's tough for smaller retailers. Think about even just the investment in their businesses. Walmart's racing ahead, investing in technology and trying to improve efficiencies, leveraging technology, especially new technologies like computer vision, generative AI, whereas a much smaller company or a single brand company that's much smaller can't really do that with the same efficiencies that Walmart can and the same scale. So it does make it harder for smaller players to compete. You have to have something very differentiated, a reason for being, and to get people to kind of keep coming back on a repeat basis.
For those smaller players, how important is it potentially to see this administration open the door to potentially carve-outs and exceptions?
I think there's a lot of hope that could be the case. I know I cover some small hardline brands that actually already have that exception or had that exception with the prior round of tariffs on China back in the first Trump 1.0. And I think that there is some hope that that could be the case, and we'll have to see. And, different regions, they're not really just going after retail, right? I mean, if you were to impose tariffs on Europe, there's luxury goods come from there, but not a lot of, apparel and furnishings come from there. So I think it really depends on what the categories are, which is a good call out. But at the moment, it seems pretty broad based. And, without question, every economist that I've read seems to indicate that you're going to see some burden on the consumer.
How much front loading are we seeing? This was the story at the end of 2024. Do you still see these retailers front loading and bringing in products to avoid the blunt of those tariffs?
We've seen it a little bit where inventories have been accelerated, but not as much as you would think. And I think when we speak to the retailers, they're telling us that they're operating as if there's no tariffs at the moment. They're ready for tariffs. They're preparing. They've, kind of game planned it. They've thought about it. But the retailers that have reported earnings so far, prior to today, have not really put that tariff into their guidance. And I think that that's the approach that they're taking, which is that until we know, is President Trump using tariffs as a threat, or is he using it, to negotiate, or is he really trying to raise some revenue? And I think it's a little of both. So we may see things change come Wednesday or Thursday.
Joe, we have seen certain companies, though, step on some inventory landmines, and I'm thinking of Target specifically. What are the lessons they've learned from the more recent experience and the experience from a couple of years back?
Yeah, Target has faced this issue now a couple times, and I think, they tried to get ahead of the port strikes back in the, late summer, early fall of 2024, and, ended up getting stuck with a lot of inventory, basically. And, I think that a lot of others didn't take that approach. Target was trying to be proactive. They did it a couple of years ago, where I think coming out of the pandemic, there was a great enthusiasm about what retail sales were going to look like. So we'd like to think Target's kind of gotten that straight. They've been bringing down their inventory. We'll see tomorrow when they report earnings. We're hoping to see a better trend on the inventory side. Their in-stocks have been very good, which is a good thing because you can sell the product. But to your point, we've not seen too many retailers get too heavy with inventory. Like Walmart, for example, was not that heavy. Home Depot, Lowe's, they're pretty appropriately inventoried at the moment on a per store basis. So things look okay for a lot of the big box guys.
It wasn't just the import numbers that got our attention for the month of January. It was also the spending, Joe. I'm sure you looked at the same data. Consumer confidence has clearly shifted. It's softer. We've seen that across a couple of retail surveys now. And I just wonder, we've seen it in retail sales too, by the way, where you're expecting that to show up across the retailers.
Yeah, well, you are hearing a lot of the retailers have talked about a soft start to February. We saw kind of later as January progressed, sales seemed to have abated a little bit or eased a little bit. And I think February is off to a sluggish start for some of the retailers, especially the big box guys. Some of the smaller specialty retailers, like the apparel guys, they were able to maintain pretty solid first quarter guidance. But again, some of the big box guys, they gave a cautious outlook. They talked about weather being a big impact. We've seen that being disruptive through parts of the country this whole first quarter so far. So we'll have to see how that plays out. I think there's a lot of emphasis once again on the second half of the year that the sales trend should pick up. I think there's a lot of hope that we'll see a normalization in trends for a lot of categories as the year goes. But sitting here today, we are off to a little bit of a sluggish start. And again, the sentiment numbers have been coming a little bit weaker, in the past couple of days. So we are a little concerned. The jobs report on Friday will be a big sign of where things are headed.
Joe, a lot of people are pointing to Walmart's earnings as really touching off the sell-off that we've seen, particularly in big tech, but more broadly, this feeling that maybe it's growth concerns that are taking front stage. How much do you hear from other companies that is the case, that this is something that is more persistent, that has a more pernicious kind of feel to it, rather than just maybe companies looking to get more wiggle room and lower the bar that they can then beat later on in the year?
Yeah, what's really interesting about Walmart and some of the others like Home Depot and Lowe's last week, and their sales guidance was actually in line with what expectations were for the most part. that really wasn't the issue. It was on the earnings side. So maybe, they're not saying they're baking in some tariffs and other pressures, but maybe they are trying to. But it really is something where, as you said, they may have been lowering the bar a little bit. It seemed to us that Walmart was being conservative, Home Depot, Lowe's, that there could be a better second half that could help some of the earnings reports for these guys. But I do think that they've taken a very cautious approach with the earnings side of the P&L. Sales have been, relatively steady and in line with expectations.
Hey, Joe, good to hear from you. Joe Feldman there of Telsey Advisory Group, going into target numbers later on this week and responding to what we've heard on the retail front over the past few weeks for good reason. For good reason, right? They've got to lower the bar because you might have to lower the bar even more, particularly for home improvement companies. You start doing things with lumber, different picture for those guys very quickly.
And the idea that it's going to hit earnings suggests that they cannot pass it all along to the consumer. And we've seen that with respect to soft consumer confidence and consumer spending. So if they cannot pass that along, okay, it might not be as inflationary. It will be a hit to EPS and it will be a hit potentially to their shares.
How many times have we heard wait and see over the past few weeks? Wait and see. Heard at the business level, heard at the consumer level. Coming into February, Joe just saying just then, a lot of weakness starting to creep into some retailers to kick off the month of February.
To me, there's a real question here of how long there can be this wait and see and an outperformance in financials at a time when that's hinging on the idea of M&A picking back up.
Let's see if that spills into March. Joining us next on the programme, Steve Ricchiuto of Mizuho, Robert Tipp of PGIM Fixed Income. Lots of economic data this week, including maybe the biggest data point of the week. And it's not payrolls. It's a decision to put tariffs on Mexico, Canada and China. That decision, 24 hours away. 60 minutes away from the cash open. Equity futures positive by 0.4% on the S&P 500. On the Nasdaq, up by 0.75% with your morning movers. Here's Manus Cranny. Hey, Manus.
Jonathan, very good morning to you. What would 900 billion euros on defense look like? This is a personification of it, Rheinmetall in Europe. This would be a boom time for defense spending in Europe. JP Morgan raised the price targets across the sector by about 25%. Roll it down, have a look at Capri. We understand Prada are close to doing a deal to buy Versace, 1.5 billion. Take your mind back. FTC blocked Tapestry from bidding for Capri, and the stock dropped by 45% on that day, up 7 1/8. I'll leave you with a look at Intel. It was all that hubris around a breakup discussion. Well, today we understand NVIDIA and Broadcom are potentially testing what's called 18A to become a significant customer for Intel. And up she goes, up 6%. Jonathan.
Manus Cranny, thank you, sir. It's amazing to see this European story come together. A diplomatic breakdown in the Oval Office on Friday between two leaders, the President of the United States and the President of Ukraine. An emergency meeting for the Europeans becomes a little bit more urgent over the weekend, and they push for defence spending. The story comes out from Reuters that you're going to see more than just defence spending from the German government when they get their act together. You'll see infrastructure spending as well. Numbers pushing 400, 500, 600, 700, 800, 900 billion euros. So we've got the German debt market trading softer, bond yields higher. You've got the euro stronger going into the ECB this Thursday. CPI a little bit sticky as well on the hot side for the Europeans going into that meeting. And you've got defence stocks. Manus just went through one of them. Defence stocks across the continent absolutely surging.
There's a timing issue here, and I think it's an important one, and Mark McCormick was talking about that of TD Securities. The short term, he doesn't think this can last because there's a lot that has to happen before this gets through. Longer term, it could be a positive story for all of these things, for both of the defense stocks as well as the euro. Short term, what has to happen for it to really be a long-lasting move?
Record highs in certain parts of the European equity market this morning, including in Paris, France. Here stateside, we're focused on this. Tariffs on Canada, Mexico, China, just one day away, with a slate of economic data capping off with Friday's payrolls report. Mike McKee, our economics and policy correspondent, joins us now from Washington. Michael, what a week coming up.
Absolutely. And at 10 o'clock this morning, Eastern time, we get the first indicator that people will be watching, and that's ISM crossed 50, the expansion level for the first time since 2022 last month. Look under the hood today. Is it not just an expansion, but are we seeing inventories rise because we saw that big trade deficit in the last month? What are new orders doing? Tomorrow, I sit down with John Williams, the New York Fed Bank president, to see his reaction to whatever tariff news we get between between now and then. Could be detailed, could be still up in the air. On Wednesday, we get into the whole idea of what happens with labor markets with ADP. Thursday, jobless claims, of course, and Friday is the big one on payrolls. But Friday, payrolls even get superseded because the chairman of the Fed, Jay Powell, is speaking, and we'll get his take on everything that's happened so far, we hope.
Mike, you're also there at the NABE Policy Conference as well. Just share with us what you and others are focused on at the moment.
Well, there's a lot of talk over there, and you can see this chart here that shows that there aren't very many federal workers as part of the overall workforce. So cutting them isn't going to show up in the jobs report. But cutting workers at the statistical agencies could affect the jobs report and others. And a lot of people, a lot of the economists at the NABE meeting say that they have heard a number of folks at BLS and BEA and Census have taken the fork in the road buyout. They're afraid that more job cuts are coming there and budget cuts, and that some data series will be discontinued. And of course, Howard Lutnick yesterday talked about the idea of totally messing up GDP reporting. So there's a lot of concern about how we will know the economy is doing going forward.
Mike McKee, changing the equation for GDP one step at a time. Mike McKee, thank you, sir. Looking ahead to payrolls, 160 is the estimate in our survey. That can change. More estimates will come through. But at the moment, Lisa, the median is 160, the previous month 143.
What is a good payrolls report at a time where people are looking for some sort of deceleration, and that is the confirmation bias that people have? If you get anything below that, does that have a bigger shift on markets? What happens if you get it above it? How rapid is the sort of recalibration of just how much weakness people are pricing in?
That conversation has shifted so much in the past few weeks. Barclays were with us a little bit earlier. US recession, improbable, no longer unthinkable. That's a change. Steve Ricchiuto of Mizuho says the US fundamentals are healthy. He writes the following: the underlying strength of the business cycle is evident in the harder data releases. They will dominate in the longer run. Steve joins us now for more. Steve, good morning.
Good morning.
Thank you, sir. A lot of people have become almost bearish. Give us the constructive take on the US economy.
Well, I think there are a lot of people who've been wanting to call recession. Okay, when you think about it, since 2022, we're now on our 7th recession theme. Each one has not paired out. And I don't think this one will either. The concept that DOGE is going to create some kind of major lapse in employment growth on the government side of the equation that the private sector will not be able to absorb over time, I think is just incorrect. To the extent that people were worried about the fact that we're reducing immigration and where are all the workers going to come from, well, now if you have a transfer from public sector to private sector employment, maybe it's actually a healthy thing that takes place in terms of the economy, at least in terms of the transition. The thing you do have to worry about is negatives usually come before positives. So yes, you're in this environment now where a lot of the soft data has turned negative, a lot of people have turned negative, and therefore everyone's willing to jump on the recession story again. As I said, this is the 7th recession story since 2022. Think about that. 7 in less than 3 years. And everyone's convinced each one is going to be there, and everyone wants shock and awe type headlines. We saw a major investor in the marketplace today screaming about a global debt crisis. We saw Warren Buffett over the weekend talking about tariffs as basically a moral equivalent to war. Everyone's going for big headlines. The reality is, look at where the equity market is. We've taken out the Trump bump. That's basically what we've done. Look at the bond market. We're still well up from where we were in September, even though we're well off from the 480 high. But 480 has been a very, very strong resistance level repeatedly. So I think what we're really looking at is consolidations within markets rather than really breaking out a new trend.
We'll let politicians define bad versus good. They're in the business of doing just that. Who's the angel, who's the devil? They can decide. We're interested in markets of better versus worse. Is growth going to be better in 25 versus 24? 3% GDP down to 2.5 or up to 3.5? What are you expecting?
Well, to be honest with you, I think if we're in that 2.5 to 3 area, you're the 5th year of above trend economic growth. That's never happened before. And I don't, in the post-war period, and I don't think that's a bad performance. It's certainly a performance that's consistent with where bottom-up earnings expectations are for this year, which is around 12.5%. And then when you look at all the negative headlines about earnings, our earnings revision tracker is minus 12.6%, which means 12.6% more companies are downgrading earnings than upgrading them. 12.6 is basically correction phase. It's not contraction phase in a market. And I think these are the important fundamentals. The headlines are getting out of step with reality.
Okay, hold on a second, because it's a little bit of a straw man argument. I've got to be honest, because honestly, there have been a number of headlines that have said recession. But when we talk to investors, most of them do not say that recession is their base case. Most of them believe that this is a slowdown, but it is a market slowdown, and maybe it's catch up from some of the post-COVID period that was inflated by some of the spending by the government. How do we measure whether this is something that is underpriced as a risk in the economy, in markets, the idea that the slowdown is more significant than people thought, even if it's not recession, right? At what point is it not workable for you anymore?
Well, you got to get below trend GDP, and you've got to have an argument that you're going to sustain below trend GDP. And we're sitting in an environment right now where the Federal Reserve has cut interest rates 100 basis points. The forward structure of rates is again anticipating 50 basis points more rate cuts. We've taken 10-year note off the peak by 60 basis points. So all those factors are coming in against the balance sheets that are very, very healthy, liquidity that's still very ample in the system, excess savings globally that's being generated, going to be looking for the best alternative. So I think you have to get to a sustained period below trend GDP, and I don't see that in the cards.
So this is ultimately comes down to a Fed argument, this idea that if the Fed cuts right now in response to a weakening trend, that you think it could be the policy error that could rejigger some sort of inflation or some sort of maybe positive growth shock? Is that what you're saying?
If the Fed were to cut again in this environment, I think you'll quickly see bond yields retrace themselves back to the 480 level. I'm not so sure they break the 480 level, but I think they'll push back because people will realize fundamentally this economy, as you said, a lot of the investors you talk to, the same people, the issuers I talk to and the investors I talk to, all of these people are telling me business is really good. Things aren't a problem. And yet you have this negative headlines continuously beating on people. And I think as a result of that, you're holding down the expectations. If the Federal Reserve were to come in and cut interest rates again, I think people will quickly rethink the story.
Do you think the negative headlines, though, are actually creating uncertainty? People are on the sidelines?
I think there are people who are sitting there saying, why do I get involved at this particular juncture? By the same, in the investor side of the base. On the issuer side of the base, look at what they're doing in terms of the number of issues coming to market. They're willing to sell at these levels. They're telling you these levels are attractive. These spreads are attractive longer term. So I think what you have in here, and again, the bond market investors have pulled us down from 480 to 425. So there's been a substantial move. So I think they've put a lot of money to work. I think we're just getting to the point now where so much negative news is, and negative economic news and positive bond news. Think about what's priced into the bond market right now. 7th recession call. Not only that, Bessen's going to come up with something sleight of hand to reduce $800 billion worth of borrowing this year. Doge is going to save us $1 trillion every year for the next 10 years. All of this is priced into the market, and we're at 420. Why aren't we at 2%?
So Torsten Slok puts it this way. We're on a modest stagflation shock to the economy, not a recession. Do you see any stagflationary fears? Mohamed El-Erian said the same thing to us this morning.
Stagflation requires that you believe inflation is accelerating in an environment where the unemployment rate is rising. I don't see the unemployment rate rising. 4.1% is still below the natural rate. I mean, where do we have to be? 3.4 before they turn around and say the labor market's tight? So the reality is the labor market's healthy. And inflation is at 3, not at 2. Is that the end of the world? No. Does it suggest bond yields are expensive? Yes. But it's not the end of the world in terms of average individuals out there in the country. 2% inflation versus 3% inflation, not going to bankrupt them in a world where hourly earnings growth is going up 4.1%. And that's the other thing to look at in terms of the payroll numbers that come out on Friday, is that hourly earnings number and the unemployment rate, besides the slowdown that we're probably going to see in employment. 150,000 payroll employment is very consistent with trend GDP. Question is how much of that is a function of weather, how much of that was a function of forest fires, how much of that was a function of Doge. We don't know. The reality is when you look at the moving average of these things, they're all doing fairly healthy, especially when you look at on a year-over-year basis. They're still well within areas that support growth to the economy.
You acknowledge in the near term, though, we might see some weak prints based on what you said at the start of the conversation. The destination might be good. And I agree with you. You could increase the dynamism of the American economy by removing the government and allowing the private sector to step in. That all makes a lot of sense. In the near term, though, how much weakness would you expect to experience in the next couple of months? You might describe it as a head fake if we get here, because we'll still end up somewhere good. But I'm trying to understand what you expect in the next few months.
I mean, to be honest with you, if we got to 2% GDP, I'd be fine with it. What you saw in terms of the Atlanta Fed numbers, when you think about it, we had this massive trade deficit shock, right? Yep. It didn't show up in wholesale or retail inventories. And everyone sits here and says, well, it can't be in manufacturing inventories. Well, if you're manufacturing and you're pulling in a lot of intermediate product, we don't know the manufacturing inventories yet. We'll see them. Maybe the manufacturing inventories were very, very big. Maybe it's a big one-time shock in manufacturing. Maybe this data all gets revised. Maybe the consumer numbers get revised. The reality is you're jumping on every little marginal change when the reality is the fundamental trend has been healthy. We've called 7 recessions since 2022, and we've had an economy that is growing above trend for 4 years, going to be 5 years. Think about it. There's a disconnect between the logic and the reality.
Steve, it's good to see you and catch up as always. Thank you, sir. Steve Ricchiuto there of Mizuho. Joining us now is Robert Tipp of PGIM Fixed Income. Robert, I just want to build on what Steve just said moments ago. He's constructive on this US economy. We keep calling recessions that never happen. Where are you with the team now?
Right. So I think we're constructive, and I agree with Stephen's constructive take by and large. I think you have to ask yourself, though, the question that he asked: why is the market having this big rally? And I think that, in a standstill situation, things are fine. That's a great take, but the tariffs are looming over the market. The policy framework, the policy backdrop is changing rapidly, and people are not sure exactly what to expect. And I think there was a perception that neutral is probably lower than where we are. So that, along with the fact that investors' equity allocations are pushed up by market appreciation, money fund balances are incredibly high, that creates a strong technical backdrop where, all else equal, people get nervous that they're not in the market, in the absence of accelerating growth, in the absence of tariff threats and things not, going by the wayside. People start to buy. So I think that's what we're seeing in terms of this big rally in the market. It's not really a realization on the economic side that there's weakness out there. It's fear.
It's fear, and it's a technical buying opportunity. Maybe we just had Steve Ricchiuto on from Mizuho, and he was talking about his belief that this is a head fake, that if you look at the actual economy, it's doing pretty well. And if the Fed were to cut rates in response to this head fake, you would see 10-year Treasury yields retrace up to 480 once again. Do you agree with that?
I think that was a great point. I think that, if you think about it, that is what we have seen. The Fed did cut rates, interest rates did go up. And the Fed right now is not inclined to cut rates because the inflation picture is sticky. So I think what you have to ask yourself is, if they cut rates, all else equal, yeah, you would see rates go up. But the Fed's only going to cut if the economic picture weakens and or the inflation picture softens, and it gives them a reason to cut. Because right now they're standing, pretty firm. So I think, the things that we've seen in terms of developments of the last 72 hours are risk reducers, maybe not from the perspective of Ukraine itself, but from a global perspective, the U.S. and Russia resuming diplomatic, not necessarily relations at this point, but beginning to, sit at the table, I think is a risk reducer in the way that when NATO took itself out of the Ukraine crisis in 2022, that reduced systemic risk. So I think that is a positive. I think Europe working on defense and pulling together in that regard is also a balancing element. And it brings fiscal, and it could bring technology that comes along with the defense spending. So I think those are the positives. And against that backdrop, I think we're going to see a rebalancing. What we've seen is kind of a creeping wider of spreads over the last several weeks as the markets were really going past the saturation point with all of the policy changes and some weaker data. I think now you may see the rates picture stabilize or some inching higher of rates. Well, maybe spreads begin to get traction as the market wraps itself around this new set of news.
There's so much to unpack within that, Robert. I want to just go right to where you brought up, which is the idea of more military spending in Europe. And we see yields creeping higher over in the European region and then in sympathy in the U.S. When does that become something that could send yields globally somewhat significantly higher if there is a huge injection of fiscal spending in Europe?
Yeah, well, let's see how this goes. Bazooka is not the typical response in Europe, but they have shown an ability to react in recent years. So I think you will get something. It will have a marginal impact in terms of where government bonds trade relative to swaps. And we've already seen that where bonds and have cheapened relative to swaps in Europe. And if Germany is the big spender, we'll see it there. If it's Europe-wide spending, we'll see widening of spreads there. But I don't think you're going to see it on a destabilizing level. But you will see it in terms of government spreads. In the U.S., I think there's an element of that has been positive. We have seen massive Treasury issuance. We've seen Treasuries widen relative to swaps. Those yields have pushed higher relative to swaps. I think that is an element of the positive credit backdrop that we've had in the U.S. and corporate spread tightening. So I think you're going to get a good balance. It's going to continue to be a pretty good range-bound fixed income investment environment, despite all these crosswinds or because of them.
Robert, I just want to jump in and just extend this a further 60 seconds. Help me understand if there's space for Germany to do the kind of things they want to do. I understand they have the fiscal space. This is a market question. Do we have the market space? And if we are buying highly rated German debt and there's a whole lot more of it, what are we selling?
Yeah, I think, this market is by and large underinvested when you look at the cash balances, the money fund balances. So I think the money is there, number one. And in terms of the first part of your question was?
Well, the question ultimately, Robert, is whether we have the space to do this. And I'm not talking about the fiscal space. I'm talking about the market space.
Right.
And if I'm buying bonds, am I selling something to finance that? Am I selling treasuries?
Yeah.
Am I selling something else on the continent, something else denominated in euros?
Yeah, I think it depends on the central bank posture. If we were in a central bank rate hiking cycle and we were getting pro-cyclical fiscal stimulus, this would be a huge problem. But we're at 275 on the way down in terms of the ECB's deposit rate. They are accommodative. I don't think the market is going to have any major problems in terms of absorbing another 100 or 200 billion coming into the system, say, in the next few quarters.
Robert Tipp, appreciate it. Thank you, sir. Robert Tipp there, PGIM Fixed Income. Bramo, all things we need to think about in the coming months, potentially, coming quarters, coming years.
Yeah, especially if maybe the market can absorb 100 or 200 million in new bond issuance. What about $1 trillion in new bond issuance, which is some of the proposals out there?
Trying to figure that out. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Some other German news for you. Sources there reporting that several people were injured, some critically, after a car drove into a pedestrian zone in the city of Mannheim. Sources say an SUV was driven at high speeds into a crowd of people. The driver has been arrested. The incident comes just after 2 people were killed in a car ramming attack in Munich. Firefighters battled over 170 blazes across North and South Carolina over the weekend. Strong winds and dry conditions fueled fast-moving wildfires, prompting evacuations and emergency declarations. Despite the fire's intensity, no injuries or structural losses have been reported. Disney-owned Hulu crashed during the Oscars last night, shutting out tens of thousands of customers during one of Hollywood's biggest events. As the awards show began, people were unable to log on to Hulu, which was broadcasting the event for the first time. The outage was resolved after about 2 hours. And that's your brief. John.
Danny, thank you. Thanks for this morning. Up next on the programme, we'll set you up for a busy week ahead. The week is absolutely packed. From New York, this is Bloomberg. The opening bout a little more than 35 minutes away. Equity futures positive by 0.4% on the S&P 500. On the Nasdaq 100 up by 0.7. Your week ahead might take a while to get through. This is what it looks like today. President Trump making an investment announcement at 1:30 Eastern Time. Tomorrow, Trump's tariffs going into effect on Mexico, Canada, an additional 10% on China. Plus, President Trump delivers his joint address to Congress on Wednesday. ADP, PMIs, plus the Fed's Beige Book Thursday. Jobless claims Friday, a payrolls report, and comments from Fed Chair Jay Powell. That's your week ahead.
Can't wait for the beige book. Just kidding. Look, we're all looking for what happens tomorrow. That's going to set the tone no matter what. And it's not just the tariffs. It's also State of the Union to really understand what the priorities are. After that, it is the economic data and how much there is a confirmation or a rejection of some of the weakness we've seen soon.
Technically, we wouldn't call this a State of the Union because it's still too early in the president's term. However, he's got so much done in the first few weeks that I think we can call this a State of the Union.
It pretty much is a State of the Union. Basically what he's saying, at least this morning, an hour ago on Truth, tomorrow night will be big. I will tell it like it is. I just want to know the tariffs. Does he come into that State of the Union joint address saying, I got great concessions from Mexico or Canada? Does he come in saying, I am going for reciprocal tariffs. I'm punishing those who let migrants in and fentanyl in, and the 25% went on?
We're going to find out in the next 24 hours. Coming up tomorrow to react, Julian Emmanuel of Evercore, Sucharita Kodali of Forrester Research, Stuart Kaiser of Citi, Michael Gapin of Morgan Stanley. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.